Hi. So we are starting with a formula batch. Now, when we are doing the formula, what is the objective of it and when should you do these formulas? First of all, my name is Kunal Doshi. I'm chartered financial analyst. I started my CFA journey in 2009. Probably you were in the school at that time. So CFA is my passion. And today I would like to say that why formulas are essential. Now, do I need to memorize the formula? Absolutely not. Can I clear the exam without writing the formula? Absolutely yes. But what I realize as a student that when I write down the formulas, indirectly I'm revising it. So it's just not writing or copy pasting because these days we are used to less writing and more reading or less reading and more watching. So I'm going back to the traditional method which I used to follow, which helped me memorize or understand both. You may not realize right now, but when you go to the exam, because you've written the formula, it stays in your head. This is my philosophy. So this batch is exclusively where we are going to revise the formulas. Now, when you are revising the formulas with me, we'll strictly focus to the formula because by now, I'm sure you have revised the whole syllabus once at least or more than once. That is the bare minimum. So there is just a dilemma that students have that there are too many formulas in CFA. Well, I agree with that. Even if the exam may not be that practical, it's more theoretical as what you see in the syllabus. But still, there are so many formulas. So the objective of this batch is to summarize all the formula topic wise, indirectly revising them in our head, and you will write down all the formulas with me because see you might get a sheet from chat gpt also about all the formulas. If you put on ai tools and write down I need all the formulas, it will automatically give you, but you find it difficult to memorize all and you don't have to, so it's better you write it. Okay, everyone, cool. I hope with all this positivity, we start the session. You have the book and pen with you, and I will start doing the formulas in the same order as what it is in our book. In our fast track revision book, we have the topics in the same order. We'll start with your morning session part A or part one, whatever you call it. We will start with quants, followed by FSA, financial statement, that is corporate issuers, economics. Ethics may not have formula, but some vital numbers that you need to know. Equity investments, fixed income, a lot of formulas like quants. Derivatives, yes, some formulas. Alternative investments, a couple of formulas. And portfolio management, many formulas similar to quants. All good? Your weightage, by now you've realized that quants have lesser weightage, but more importance. Correct? Ethics has more weightage and very high importance. And some topics are relatively easier, like alt or corporate issuers, but they have good amount of weightage. So this is the whole syllabus. All right. Now let's start first with quantitative methods. And in quantitative methods, as you're aware, 6 to 9% weightage. There are total of how many readings? We understand there are total of 11 readings. Of that, the first 10 reading is where you have a lot of formulas. Okay. Let's start with the readings and with the formulas. Many of these formulas are repeated in the other part. So first formula that we are going to start about cons, and I hope you have the book with you. Yes. Okay. The first formula is risk-free, nominal risk-free rate or nominal rate. So what is the nominal rate? I'm starting with cons, by the way, just writing it for formality. We are starting with quantitative methods. Guys, my handwriting are amazing, as you can see. So it's better you also write with me. I want you to write with me. Okay. Again, if in case if you are struggling, what is this written? Please come and check here. Okay. I will also mark here so that you are aware about this. We are first doing these formulas, that is the interest rate related formulas. Okay. So nominal rate is a combination of nominal risk-free rate, everyone. This is also the rate of government bonds. All right. Nominal risk-free rate. And we add risk premium. Risk premium is for the additional risk. So in the nominal risk-free rate, everyone, nominal risk-free rate is a combination of What else? Nominal risk-free rate is also something that you do in Fisher effect in economics. It is the real risk-free rate, real risk-free rate. And can anyone tell me? Yes, because if you guys are also involved in this, it will be an amazing thing. Yes, real risk-free rate. Come on, let's revise together. Plus expected inflation. Good. Plus expected inflation. Right? Risk premium are related to what? Risk premium, you learn that in fixed income also, they are related to three things: credit or default risk premium, liquidity is the ability to sell, liquidity risk premium. All right. And then you have the third risk premium, which is related to maturity risk premium. You will see many of these risk premium discussed in detail in fixed income. Am I correct? So nominal rate is nominal risk-free rate plus risk premium. Nominal risk-free rate is real risk-free plus expected inflation. Risk premiums can be related to default, liquidity, and maturity risk premium. Everyone with me on this? Yes, this covers our different types of risk return. All right. Now, different types of returns throughout the syllabus, and you will see them coming up again and again in various other names. So we are going to first focus on different types of holding period returns. You have holding period returns for a specific year or for a single period, then for multiple period. Then you have annualized holding period returns also. So let us write all the different versions of holding period return, everyone in the class. So what is my holding period return? Simply said, it is ending minus beginning over beginning into 100, assuming there is no income. But if there is income like dividend or coupon in bonds or rent in real estate, then we will do what? Along with ending value, we will add the income. I'll repeat, this income can be dividend, coupon, or anything. Ending plus income over the beginning value minus 1. You can use this shortcut also, ending plus income over beginning minus 1. You can use this as well, or you can use ending plus income minus beginning over beginning into 100. You can use either of the formulas, doesn't matter. So you can use this shortcut also, ending plus income over beginning minus 1, everything into 100, because you're going to calculate in percentage into 100. Clear? Guys, as you feel it's clear, understood, ping me so I can move on. Okay. This holding period return is so often used throughout the syllabus in various forms. This is single period. This is for a single period. But if it is for multi-period, in that case, my holding period return for each period we take and compound them, but we don't average it. So what I do, I will take holding period return for 1 year, then I will take holding period return for 2 year into 3 year, and so on. Likewise, I will keep on compounding multiple period holding period returns. And then what we do, everyone in the class, we do average? No, we don't do the average. That's what we do for geometric mean. Here we don't do the average. So we keep it as it is, minus 1, and of course into 100. At the end of the day, everything into 100 to convert into percentage. Now there is annualized HPR also, but before I go to annualized HPR, can I tell you that this is similar to what? This formula is similar to geometric mean. Absolutely. This formula is same as geometric mean. So even though we have to discuss holding period return, that is annualized HPR, but before I discuss the annualized version of HPR, everyone in the class, understand how the holding period return and geometric mean are to a large extent similar. So if I were to say geometric mean, everyone, geometric mean, I will take annual returns, everyone in the class, 1 plus return for first year, then 1 plus return for second year, third year, and so on. And in this example, since I'm taking 3 years, until now, it seems similar to HPR, right? But now what I will do, I will do to the power of 1 over n, number of years. In this case, I've taken 3, so I will take 3. I'll repeat, actually it is 1 over n, depending on number of years. This will average it, minus 1 into 100. This geometric mean is also called compounded annualized returns. I'll repeat, this is also called compounded annualized return, used to calculate multiple period returns. Where all this is used? Well, it's the exact thing that you will use for money weighted rate of return. Do we use it for money weighted or time weighted? Everyone, can you connect it? Money or time weighted? We use this for, the name is important, time weighted. So for time weighted return, or we will use for compounded annualized growth rate. So you will use the same concept for various reasons: compounded annualized growth rate, time weighted rate of return. That is where we use this geometric mean. Everyone, whenever they say returns over a period of time, average return over a period of time, that is where we use geometric mean. All right. So the reason I did geometric mean is to just show you how multi-period, holding period return and geometric mean are to a large extent similar, but without average, not. Okay, we have to do the average for geometric mean. Is that clear? Annualize HPR. Where do we use the concept of annualize HPR? Well, annualize HPR, this concept we use when we are trying to find the returns for a bond which is less than a year. So money market instruments, they are invested for less than a year. So in that case, if I want to find an annualized return, we do the annualize HPR. So yes, annualize HPR, everyone in the class, annualize HPR will be whatever is your holding period return, correct, plus 1, and compound this with days, 365 over days. This is what you will do to the power 365 over days minus 1 at the end of the day. Everything minus 1 into 100 at the end of the day. Okay, minus 1 into 100. Don't forget that. This annualized HPR, I'll repeat, and you can write if you want.
Good morning.
Hi. This you can write. Hello. Yeah.
Good morning. Good morning.
Hi. Yes. All right. So annualize HPR, everyone, right? Okay. Now I'll repeat, annualize HPR is used for what? Annualize HPR is used when you're finding returns for money market securities. In between, I would just like to address this thing that what about this nominal and real risk free? In exam, how am I going to apply? Well, in exam, just to address here, most of the time the focus is going to be on the probably on the nominal and real risk free rate. Now you see we've done the simple addition, nominal risk free is real risk free plus expected inflation. That is an approximate relation. If you notice here, that is an approximate relation. You notice here approximate. Yes, this relationship is approximate relationship. Nominal equals to real plus inflation. Actual relation is compounded. So we are doing, since everything compounded, actual relation, in case if asked only in quants, you will use 1 plus nominal equals to 1 plus real into 1 plus inflation. All right, everyone, clear? So this is the actual relation as mentioned in the notes, in case if just tested this. Clear? Okay. Now, what are the different types of mean? Mean are in different sections. Mean are in reading 1 as well as reading 3. Number 1, yes, different types of mean. Arithmetic mean. Arithmetic mean. Arithmetic mean is what? Simple returns for 1 year, 2 year, 3 year, depending on all. Summation of returns divided by n. So you can use multiple year returns, summation of x divided by n. That's your simple arithmetic returns. Clear, everyone? Or arithmetic mean? Hello, guys, are you there? Yes. All right. Yes. Okay. Arithmetic mean, geometric mean. Arithmetic mean is used when they ask you expected returns. I'll repeat at any time you have any struggle in the formula, check out here. Okay. You can see here arithmetic mean. We will first focus on arithmetic mean, geometric, weighted, and harmonic. All different types of means. So geometric we discussed. Weighted mean is used to find portfolio returns, if you are aware. Remember, this formula is used so many times. Can you tell me which all times? Write in the chat box where all you have used this. I'm excited to know. Weight of A, return on A, weight of B, return on B, and so on. All right. Yes. I want to see whether you know where all you have used these formulas. Portfolio return, that's it. Weighted average cost of capital, correct? Yes. Weighted average cost of capital also. One more. Come on, come on. I'm interested. Portfolio standard deviation, no. Weighted. Mean. Guys, anyone? Portfolio duration. Portfolio beta. The same concept is used for portfolio duration, portfolio beta also. Okay. Clear? Yes. Now, harmonic mean. Harmonic mean is used for what? Harmonic mean is used to find the average cost. For harmonic mean, what we do the number of investments. So the number of investment, harmonic mean, you can notice here, harmonic mean, the formula looks complicated, but it is not. It is the number of investments. So let's say if I do 5 investment, I will do n to the power, on the numerator, I will put 5. That is the number of investments. And in the denominator, we add the inverse of prices. So let's say price 1, price 2, price 3. These are different investments, investments with the same amount but at different prices. So we take the inverse of the price, add them in the denominator, and take the number of investments on the top. That is your harmonic mean. Arithmetic, geometric, harmonic mean. Out of this, there is a relationship between arithmetic, geometric, and harmonic mean. If the data is not same, if it is same, if the number of years of returns are same, then all three are same. If it is not same, what is the relation? Assuming it is not same, arithmetic is always greater than geometric, which is greater than harmonic. If the data is not same, if it is same, it doesn't matter. They're all same. Is this clear, everyone? Arithmetic, geometric, weighted, and harmonic. All right. Yes. Okay. Next, you will notice something called continuously compounded return, and this concept is also tested in the later topic in the form of log normal returns. So continuously compounded return is similar to your HPR. It's very much relevant to HPR, but that continuously compounded return, you will notice that being used later on also. Continuously compounded returns or continuously compounded rate of returns, whatever you call, which is equal to, you calculate the holding period return, right? Plus one, and then you have to just do one thing. You have to press log natural ln. So whatever is your holding period return, add 1. Let's say your holding period return is 5%. So you can just do 1.05, correct? And then 1.05 and then press ln, you will get 0.0488. Is it clear, everyone? Right? All the different forms of returns. Okay. Now, money weighted and time weighted. Money weighted rate of return is nothing but IRR. For IRR, there is no formula, but the calculator function of cash flow. You will put all the inflows and outflows in the cash flow component, and you will calculate the IRR, right? Money weighted rate of returns, IRR. Geometric mean for time weighted rate of returns, right? So they are not new formulas, but this is how you use money weighted and time weighted. The difference between gross and net fees. Yes, very simple now. Even though you don't use here, you use that in alternative investment, but the difference between gross and net returns, gross returns in an investment fund account and net returns, the difference between both is due to fees. And when I say fees, we include which fees? We include different types of fees, management fee, custodial, taxes, or other expenses. And if I am doing alternative investments, it might also have performance fee. So all the fees, all the different types of fees, management fees, custodian expenses, custodian to park your shares, custodian fees, right? Or any taxes, any component related to the management of the fund, excluding taxes. But I will write, but excluding what? Very important. Excluding brokerage or commission. Brokerage or commission. Brokerage or commission are trading expense. Why? Because brokerage and commission are already excluded from the gross returns. All right. Please keep this in mind. Excluding brokerage or commission, it is also mentioned here. It excludes the brokerage and commission because that is already subtracted from the gross returns. Is this clear, everyone? All right. Now, the difference between pre-tax, pre-tax nominal return and after tax real return. Now, you may not be required to calculate this entire adjustment, but you should know the difference between both is due to what? The difference between both is due to, yes. What is the reason behind the difference between both? Due to, the name says, is tax and inflation. Isn't it, everyone? The difference is due to taxes and inflation. So in case if tested in exam, what is the difference between both? That is tax and inflation. And as an investor, we are more interested in after tax real returns. All right, everyone? Correct. Now, there is a formula here, which I always say it is actually related to equity, but you will notice that in quants also, that is leverage returns. In equity, we use this formula leverage returns. Now, leverage return, where do we use in equity? We calculate to find return on investments in, so, or return on investment or ROE in equity. So what is my leverage returns formula? Now, just by looking at the formula, you may not realize what exactly it is. So understand the component. There are two components. One is your own fund, right? And one is the borrowed fund. Two components here. Your own fund, that is equity fund, which is your margin, and B is the borrowed fund. R is the return on the portfolio, and B or RB is the return on the borrowed, that is interest on the borrowed fund, I should say. Correct? So when you are investing, your portfolio will generate returns. Your returns will be on both the money, right? Your own money plus borrowed. But when it comes to paying the interest, interest is only paid on the borrowed amount. That is the margin amount. Correct? That is the borrowed fund at a call rate. Sorry, not margin amount, but at a call rate. Call rate is called the margin rate. Divide by my investment. My investment is V0 or VB or both. My investment is only V0. Everyone in the class, V0 is your investment. I'll repeat, V0 is your investment. VB is the borrowed fund. So if there was a 20% margin, my investment is 20, 80 is borrowed. Understood? And the interest is calculated on 80, the borrowed amount. That is what the interest is calculated on, but return on investment is on my investment, that is 20. All right. These are leverage returns. Don't worry. More detail about the leverage return, the components of leverage returns, we understand that in equity. In equity, when we do equity, we understand the leverage return components. All good, everyone? Perfect till this case. The first reading, massive, too many formulas. All right, let's move to the second reading, which is pretty much easier, time value of money. In this case, unfortunately, not unfortunately, it's a good news that most of the times you don't need to memorize the formula because all of them are in the calculator function of PMT. Yes, PMT function that we use. In that case, we use all these functions like N, I by Y, FV, PV, and PMT. All five components will help you find either of the amount, either FV, PV, or PMT. Correct? So in this case, even though there is a formula, if you notice this formula, I will just focus on this formula. Isn't this the formula of no arbitrage forward price? If you see it similarly, FV equals to what? PV into 1 plus R to the power T. Now, I'll repeat, you may not need this formula to be used in exam in quants. By the way, let me tell you, we are in reading number 2 now. But this formula that future value equals to present value into 1 plus R to the power of T. And if I simultaneously want to find present value, I will take future value and divide it by 1 plus R to the power of T. This is used where? This is used to find the no arbitrage forward price. And if you notice present, instead of present value, what do we write? We write S0. This is what we write forward equals to 1 plus risk free to the power T. Same concept. All right. When we want to find present value S0, we discount the future value. When we want to find the future value, we compound. That compounding is 1 plus R to the power T. Is this clear, everyone? All right. Yes. We don't need the formula of exponential, but we need to know how to find nominal to effective rate. Yes. So how do we find the nominal to effective rate? Now, nominal to effective rate, everyone. Now, whenever I want to find nominal to effective rate, my suggestion to the class is do not use any formula. Whenever they ask you to find nominal to effective or vice versa, you will use a calculator function that is second icon V. Second icon V is nothing but second 2. You will use the calculator function only. I will strictly tell you not to memorize any formula for this. Otherwise, you may end up making mistake. In second icon V, you get the nominal function, you have the effective, and you have the compounding. Compounding annual is 1, semi-annual is 2, quarterly is 4, monthly is 12, daily is 365. But for continuous compounding, you should remember, for continuous compounding rate of interest, you will put 999. Okay, if you just do 999, that does the job. Are you with me? Yes. Tell me. Clear, everyone? All good? Okay. So you will use 999 in case if you have to use continuously compounding. Otherwise, you don't need to. Perfect. All right. Yes. Now, in this topic, is there any other thing that I need to know? Yes, you need to know there is whenever you use PMT and basically whenever you use the annuities, right? This is where you use maximum during fixed income. Just one thing that I've mentioned to the students very clearly that throughout the syllabus, we are doing which rate of interest? Compounding. So now I can connect things. For example, your IRR, your geometric mean, correct? And what else? What is compounding? YTM. All of that is compounding. Compounding, remember. So they consider reinvestment at the same rate. Now, because of higher the reinvestment, larger will be the difference between simple and compounded rate. All right. And a very important note that I mentioned to the students always that whenever you are doing the annuity function, remember PV and FV will never have same sign, will not have same sign. If you have both same sign, the calculator will result in error. Is this clear? PV and FE should have different signs. Otherwise, the calculator will be in error. Now, where do I use PV and FE both? For example, for loan calculation, for loan amortization. Now, loan, whenever you take a loan amount, you take the loan for a particular tenure, right, at a specific rate of interest. And at the end, what is the payment? That is future value. And the installments are called PMT. So what is the loan amount, tenure, interest rate, FV and installment in our calculator called as, guys? As per the calculator, they are called loan amount is your, yes, PV. Tenure is your N, correct? Rate of interest is your I by Y. FV in loan amortization, FV is always zero, because when you pay all the installment, FV is always zero. Keep this in mind. Installment is your PMT, right? This is so useful concept used across the syllabus. Now just remember here that the PV, of course, FV is zero. So if you put the PV as positive, your installment will be negative. If you put PV as negative, your installment will be positive. Doesn't matter. Okay. The institute is not going to fight with you for plus minus signs. Is this clear, everyone? Loan installments, correct? All right. Now, a very simple formula for perpetuity. Perpetuity. Now, if you recollect, first of all, what is the perpetuity formula? In that, the cash flow is forever. So in this case, if I want to find PV, we take simply the calculator functions. What we take the PMT and divide it by I by Y. PMT and divide by I by Y. Now, the same thing when you do the valuation for a perpetual preferred stock or a perpetual bond, the formula will be same, just that the names will change. If it's a perpetual preferred share, it will be preferred dividends divided by cost of preferred equity. I'll repeat, it will be preferred dividends divided by cost of equity. If it's a perpetual bond, we use coupon and divided by YTM. Just the name changes. Just the name changes. Is this clear to the class? PMT divided by I by Y is the general concept, but based on the security, only the names keep changing. Understood, everyone? Right. Now, see, we are doing formula at the end, right? So I'm assuming you have revised everything. So don't mind if I connect it with other topics. All right. Clear? Yes. Just highlighting all the formulas that we've covered. Okay. This part. Yes. There's no formula as such here, but very simple understanding though. This one formula you need to know, continuous compounding future value and all. You don't need to. You will use second two function and perpetuity formula. Okay. Now comes the giant, which is reading number 3. Reading number 3 has enormous formulas, right? Starting with mean median mode. And when I say mean median mode, here we are saying arithmetic mean only. So arithmetic mean, no need of memorizing the formula now. You already know that is summation of x over n. We already did that. Median also does not have a formula, but you need to know that you need to arrange everything in order and you need to find the value in the middle. If it's odd number, it's easy to find the value in the middle. If it's even number, you have to take the average of two in the middle. So there's no formula for median. There's no formula for mode, the most repeated. Is this clear? Even the outlier adjustment doesn't have formula. We don't adjust any, we don't use any formula in Venn-serized or trim mean. But location of data does have formula. How many of you have, those who were not with me in the revision, how many of you have seen this in your notes somewhere? Location. Because I see less mention about it many places, right? Those who are with me in the revision and full course, they know this. But location of data, please write down the first formula we are going to focus here is location of data. Location of data always gives you the value which is at or below that point. Okay, so location is nothing but n plus 1. So whatever is a sample, if it's 10 years data, so it is n plus 1, 10 plus 1 into percentile. Percentile. Everyone, that is location of the data. Everyone, correct? Yes. All right. All right. Very important formula, location of data. Please keep in mind, right? In case if tested. Now, very important are the standard deviation. Do I have to remember all these formulas? May not be, but let's write it down. Absolute and relative dispersion. So, what are the absolute and relative dispersions? First, we'll focus on the absolute dispersion. We'll start with range, very easy. That is the highest value minus the lowest value. No problem with that. Mean absolute deviation. We take the difference in the value, that is x minus x bar. X bar is the average. And we take the absolute values, sum it up, and divide it by the sample. Is mad mean absolute division, does it have a calculator shortcut function, or do I have to do it manually? In exam you have to do it manually only. X minus x bar, that is the mean, sum it up, divide by n. There's no shortcut for this. All right, clear? Range, mean absolute deviation. Now, standard deviation and variance. We'll focus on standard deviation. And when I'm saying standard deviation, we are always focusing on sample standard deviation. Sample standard deviation. So if I want to now calculate sample standard deviation, you do not have to do this because there is a calculator function for this. But the problem is that for target semi-standard deviation, there is no calculator function. So just for your reference, writing sample standard deviation so that you can relate it. I'll repeat, sample standard deviation do not need formula, because for that we use a calculator function. If you are aware, we use second 7, second 8, 1v. Correct? But for your reference, what is standard deviation formula? We do x minus x bar, the whole square, then sum it up, correct? Then we do what? Then sum it up. Doing the square erases the issue of negative. So then sum it up, and then we will divide by sample. If it is sample, we do n minus 1. N minus 1. I'll repeat, you don't have to manually do it, but still n minus 1. And all of this to the power root. If they ask you standard deviation, if they ask you variance, keep it as it is. All right. No need to manually calculate it when you have the calculator function second 7, second 8, 1v. Target standard deviation. Yes, in this case, you have to look at the values which are below the target. Below the target, and then square it, sum it, and do n minus 1 and root it. Now, this formula, even though I'm writing it, but it is better understood with a question. So when you do a question, you will only look at the values which are below the target. The target will be provided to you in the exam. So let's say the target is 5%. So all the values below the target, you will find the difference, square it, divide it by n minus 1. If it's variance, keep it as it is. If it is standard deviation, take the root of it. Unfortunately, MAD and target standard deviation, which are very favorite of the institute also. Why? Because there is no shortcut. You have to manually do it. Clear, everyone? This is location. These are all absolute dispersion. Yes. Everyone understood? Right? Absolute dispersion. In absolute dispersion, we do not connect the risk and return. We only focus on risk. In relative dispersion, what we are going to do is that we are going to connect the risk and return. So relative dispersion, everyone in the class. In relative dispersion, what we do is that we connect the risk return. That relative dispersion is CV, coefficient of variation, which is risk over return. Risk over return, and risk over return here is nothing but the standard deviation of X over the average of X. And remember, this ratio you want it to be lower. Lower the ratio, the better is the ranking. Is this clear, everyone in the class? Relative dispersion. Any questions till this point? All good? All the different types of dispersion. I'll repeat: MAD and target semi variance or target semi standard deviation does not have a shortcut. You'll have to manually do it. Rest all this sample variance or standard deviation, you can use second 7, second 8, 1V. Coefficient of variation, risk over return, used for ranking the portfolios. Now comes skewness and kurtosis. Guys, skewness and kurtosis, you do not have to calculate in exam, but I will write something very important. The three types of risk we will focus on: variance, skewness, and kurtosis. Kurtosis. Variance is square. Yes or no? Variance is always in square terms, correct? Square terms. Skewness is in cube. And kurtosis is to the power 4. So kurtosis is to the power 4. What does it mean? That can the variance be ever negative? No, variance will always be positive, and kurtosis will also always be positive, but skewness can be negative or positive. Understood, everyone? Also, when is the skewness significant? If the skewness is, everyone in the class, if the skewness is greater than 0.5 on either of the sides, on the plus or the negative, that is considered significant. That is considered significant. I'll repeat, skewness is considered significant if it is greater than 0.5 on plus or minus side, doesn't matter. But kurtosis, when do I say it is not normally distributed? When the kurtosis is, everyone in the class, greater than 3. Kurtosis greater than 3 is risky. Yes or no, everyone in the class? Got it? Skewness, kurtosis. Everyone, please check out in the notes. Skewness of greater than 0.5 is considered significant. Kurtosis greater than 3. If it is 3, it is considered normally distributed. Greater than 3 is called leptokurtic. Greater than 3 is called leptokurtic. Correct, everyone? All right. Yes. Now let's focus on correlation and covariance. Now there is a formula for covariance. Let's say covariance for two security, but there are two formulas. One is with probability, one is without probability. We are going to be mostly tested the probability side. But still, in case if you want to know without probability how we do it, we take x minus x bar, multiply with y minus y bar, sum it up, and then divide it by n minus 1 considering sample. This is your covariance formula, but you don't use this. You use the probability one. And what is the probability one covariance formula, guys? It's in the next topic, but still it is x minus x bar into y minus y bar. That is the difference between x with its mean, y with its mean, and into, yes, into probability, and we sum it up. But we don't do n minus 1 if it's probability, because the total of all probability is always 1. Are you with me on this? Everyone? Check and understood this or not. This is the formula which is not done through calculator. You will have to manually do it. Correlation is derived. So when I calculate correlation of xy, it is derived from covariance. What do? We divide the covariance with the standard deviation of x and y's multiple. So we multiply standard deviation of x and y, we divide the covariance with that. That will give me correlation. Is this clear to the class? Covariance and correlation. Everyone, covariance ranges from minus infinity to plus infinity. The problem with covariance is it goes from minus infinity to plus infinity, but with correlation, it goes from -1 to +1. All good? Correlation formula is also repeated in portfolio. Cool. This is your covariance and correlation formula. Until this point, everyone clear? The first 3 readings are where the maximum formulas are. All good till this point? Okay. Yes. Any doubts till this case? All good? Yes. Now, in the concept of probability, very important formula is the base formula. All right. But the base formula, before that, it is important to understand the multiplication rule. Yes. Multiplication rule focuses on the concept that 2 events happening together. That is a conditional and unconditional. And based on that, we do the base formula. So let us do the base formula, everyone. This is the perhaps the important thing in this topic, right? Base formula. So we will focus on the base formula. Now, base formula, those who are probably are learning from me for the first time, it focuses on the flip probability. Means if I want to find, let's say, what is the joint probability or multiplication rule? Multiplication rule is that if I use a conditional probability multiply with unconditional probability, that is called the joint probability of AB. Or if I say probability of BA into probability of A is nothing but probability of BA. Well, are they both different or same? Are they both different or same? They both are, everyone in the class, same. Correct? Now, since they both are same, it translates into an amazing relationship that now if I use probability of A given B into probability of B, this is unconditional, conditional and unconditional, should match to probability of B given A into probability of A. So let's say if I have to find this probability, so I need to have the flip of it and multiplied with the unconditional probability of A. Then what will happen? My final outcome for probability of A given B will be B given A into probability of A over the probability of B. Now, let me tell you what are these probabilities, okay? First of all, this is nothing but probability of BA or AB, which is the same. And this is nothing but probability of B. Now, if you carefully observe, everyone, the numerator is what probability? Is it a joint probability? Yes or no? It's a, the numerator that you notice here is a joint probability. And the denominator is a, yes, anyone would like to comment? If this is a joint probability, the denominator is a total probability. Always. So in the base formula, it is the joint divided by the total. That is what you will notice. Is this clear to the class? This is highly testable, and this is something that you should expect if something from this topic. This is the most important as per me. So you will have a scenario where you will have B given A, probability of A. So you will make a tree. that is the joint probability, divide by the total of B, that is total of B, total probability, right? This should give you A given B. So whenever they ask you the flip of it, we use the base formula. This formula you need to know, joint over the total. I have in the class told the students not this angle. In the class, I have discussed with the student that to understand the base formula, it is better you understand the diagram. So we have in the class done through diagram, but just for your understanding, we are doing the formula because we have done base formula. Those who have studied from me know that base formula we've not done using this way. We've done using the diagram, the tree diagram. Clear, everyone? Right? So formula, do I need to memorize the formula? Well, you may not if you know the tree diagram process that we've done, because in that we do it without the formula. Got it? Yes, that's perhaps the important point in this. In case of my revision book, I think there is an error here. This is A given B is B given A and so on, right? There is some error in one part of the book, which is this. Okay, so you can ignore this. You can simply write down what I just wrote. Okay, in the notes, they have mentioned in the form of event and information. So it is event slash information, and the flip is what we have. We have information slash event. All right. Yes, all other formulas you may not require to understand or remember because you know the basic probability rule that the probability of any event is between 0 to 1 and the total of all probability is always 1. So that rule I'm not writing, which I'm sure everyone is aware. Reading number 5. Yes, this topic of reading number 5 is exactly everything repeated in portfolio, isn't it? Here, expected return and variance. First of all, do we need to do this manually? Do we do this manually? No, we use second 7, second 8 function 1b, where we put the value of stock of the returns in X, and in Y we put the probability. So in X and Y, in Y we put the probability, in X we put the returns. This is what we do, and we do not do this manually. We do not do this manually, right? Mean, variance, standard deviation. Covariance, portfolio return, portfolio standard deviation, yes. So even though these formulas are repeated, right? Covariance by now, I'm sure everyone knows. I'll still write it again. What is the covariance formula with probability, everyone in the class? X minus X bar multiplied with Y minus Y bar multiplied with the probability and sum it up. That is a covariance. Put all together in portfolio return, we've already done using weighted return. So portfolio return is, let's say, two securities, weights into the returns. But portfolio standard deviation, remember, risk is always calculated in variance and then converted into standard deviation. Two securities, yes, very important. Weight of A square, variance of A, plus weight of B square, variance of B, plus 2WA, WB, covariance AB, and the root of all of this. In case if they ask you standard deviation, correct? Now here covariance can be broken down further into, if not covariance, we can use correlation AB into standard deviation A into standard deviation B. So the only thing I might replace is that instead of covariance, I can use correlation into the standard deviation. Is the class clear with this? Portfolio return and portfolio risk in exam, you're lucky enough in level 1 and in level 2 also, you are going to be calculating portfolio risk for two securities only, if you notice. Is this clear, everyone? Perfect. Now, the next ratio are two ratios that I will focus here is Roy's safety first ratio. What is Roy's safety first ratio? Roy's safety first ratio. It measures the excess return to something. So what is that excess return? Excess return is portfolio return over the target divided by the standard deviation. So let's say portfolio return minus the L. L is threshold or target. L is threshold or target returns, right? The minimum return required by the investor, threshold. Divide by the standard deviation of portfolio. That is your Roy's safety first ratio. Higher the ratio, the better it is. Can you connect this ratio with something? It is similar to some other ratio. If you recollect, if I do portfolio return minus risk-free over standard deviation, it becomes Sharpe ratio. Sharpe ratio. Everyone in the class? Yes. So if my target is risk-free, then both the ratios are same, isn't it? If my target is risk-free, then both ratios are same. Safety first ratio and Sharpe ratio. Remember safety first ratio. So higher safety first ratio is better, yes or no? Correct. But higher safety first ratio also means what? Also means lower shortfall risk. Lower shortfall risk. Please note down, higher safety first ratio also means lower shortfall risk. Is the class clear with this? Even though we don't discuss Sharpe ratio here, but we write down both so that we know how they're connected. All good, everyone? Reading number 5. Check out safety first ratio. These are brief readings. And shortfall risk. Higher safety first ratio is lower shortfall risk. Shortfall risk is actually nothing but a Z value, which we do not have to calculate now in level 1, but it was something that we used to calculate before. Okay. Now, in the simulation topic, you have a formula of log normal or continuous return, which is same, which we already discussed. This returns, we are not calculating again. This is continuously compounded or log normal returns, which we already calculate. Log normal is a distribution where it is bounded by 0 and it is skewed on the right. It is tail is on the one side. Okay, Monte Carlo simulation, there is no formula. So reading number 6 has no formulas. Clear, everyone? I mean, there is a formula, but we've already covered it, right? In the previous reading. I hope everyone remembers that, correct? Reading number 7, yes, in this case, we have a formula for standard error. Standard error. What is the standard error formula? Yes. So if I put across now reading number 6, there is no formula. I will focus on reading number 7. Standard error is the standard deviation of the sample. So what is standard error, everyone? Standard error formula. It is population standard deviation over the root of n. If population standard deviation is not available, then if this is not available, if not available, if population standard deviation is not available, then only what we do, if population standard deviation is not available, then we calculate the standard error with what? Sample standard deviation over root of n. That will become my standard error. So I will use this standard error if population standard deviation is not available. So basic standard error is nothing but standard deviation over root of n. And if it is not available, then I will use the sample. Is this clear to the class? All right, everyone? Okay. Yes. Now it's not a formula, but I will write down what is necessary for the concept of central limit theorem. 3 things necessary for central limit theorem. If you remember, what is central limit theorem? Central limit theorem. What are the 3 essential things, everyone in the class, in central limit theorem? Number 1, the sample mean should be equal to population mean. Sample standard deviation should be, or we rather say in variance, sample variance should be equal to population variance divided by the sample size. And now if you notice, This is nothing but standard error. If I do the root of this becomes standard error, isn't it? Are you understanding this? If I do the root of this second point, it becomes what? Standard error. And the third and the most critical, that the minimum sample size should be greater than 30. All good, everyone? Sample should be greater than 30. These three things are essential in central limit theorem. I hope everyone remembers this. Cool, everyone? Check. Got it? Yes. Now, in hypothesis, very important, in hypothesis, which formula is the most important? Do I have to remember the test statistics? Everyone in the class? Do I have to remember the test statistics? May not be. Okay. But everyone in the class, in this case, you should know the error. What is type 1 and type 2 error? And even though it's not a formula, but everyone will write down with me. It is so crucial. Type 1 and type 2 error. Please tell me what is type 1 error? Type 1 error is rejecting a true null. Rejecting a true null. And type 2 is failure to reject a false null. It's there in the notes, but I want you to write it. Rejecting a true null, failure to reject a false null. Type 1 error is also called alpha, level of significance. Type 2 error, everyone, type 2 error is failure to reject a false null. But what is power of test? Can someone tell me what is power of test? Power of test is correctly rejecting a false null. That is nothing but 1 minus which error? I want to know. 1 minus which error? Type 2 error. Yes. Everyone, power of test. Type 1 error, type 2 error, and power of test. Very critical. Yes. Clear? Clear? Yes. This is where you should highlight power of test. Now, do I need to remember all the test statistics? No. But a simple test statistic formula, you should know what is the difference between sample minus the hypothesized value over the standard error. A simple test statistic formula I'll repeat. You may not require all of this because the institute perhaps may give you the test statistic value. But test statistic, everyone in the class should know, it is the sample minus the hypothesized over the standard error which we just calculated. Okay, that is the basic formula. But more than this, the important thing is you should know the different types of test. Before that, for critical value, the z value is what you should know. Am I correct? The z value. So there is confidence interval, confidence level. Everyone in the class, confidence level. Then there is significance level. And then there is a C value for it. Everyone should know these three values. So if when I say 90% confidence, so 10% significance, 95 and 99, 5% and 1%. It basically tells you how much can you go wrong. That is significance. What are the Z values for it? Everyone plus minus, because I am writing in a normal distribution, it is upside and downside both. Everyone should know these values because these values will not be provided to you. For 90%, that is 10% on both sides, we do both sides. The tail is on both sides. So what we do, we divide all by 2. I mean, you don't have to literally divide, but understand the tail is on both sides. So the Z value for this, the class should remember, it is 1.65 on both sides. 95%, it is 1.96. Yes, closer to 1. And then there is 2.58. You may not require this in exam, but what is confidence interval? Confidence interval is how much is the distance from the mean. So mean minus standard deviation into these z values. That is your confidence interval. Are you with me? That's your confidence interval. Mean minus standard deviation or standard error, right? If it's a sample standard error into the z values. Clear? Clear? You need to know all the tests. What are the tests? Yes. What are the 4 tests for 3 parameters? Yes, you can help me with the tests, everyone. For a sample mean, single mean, and then you have different types of mean, differences in mean, dependent or independent. For that, differences in mean. And then for variance, the second parameter, variance, we have single variance. And when we compare two variances, that is equality or inequality, we call equality or inequality of variance, right? And then we have correlation. For correlation, we have two types of test. One is a parametric test, and then there is a non-parametric test. All right. So what are the tests? Let us focus for mean, for variance, for correlation, and the class will give me the test names. For mean, it is Z or T. Preferably, we go for T tests. For differences in mean, always T test. Single variance is called chi-square test. Two variance is when you're comparing, you do the F test or F distribution test. Correlation parametric test is T test only. Non-parametric is called Spearman rank correlation test. Everyone, Spearman rank correlation test. There are other non-parametric tests also, generally for ranks, which are like run test, all right, which are these are also non-parametric test. Okay, so you do not have to memorize this formula. Everyone, just remember the degree of freedom for generally all is n minus 1, except for correlation it is n minus 2, because there are two variables that we are comparing in correlation. So it is n minus 2. Otherwise, you can assume it is n minus 1. No one is going to perhaps make you memorize, or you're not expected to memorize all this test statistic. Is this clear? All good with this topic? Correct. We did confidence interval, right? Confidence interval, I made you write mean instead of point estimate. I made you write mean. Instead of reliability factor, we use z values and standard error. So mean plus reliability factor into standard error. Confidence interval is also upside also and downside also. So it's actually plus minus on both sides. Okay. You can write down this, what we've written. This is more useful. Plus minus. So when I do plus and minus, it is one side. So if I want to find on both sides, I will do plus and minus. So when I do plus, it is on the upper side. When I do minus, it is on the negative side. So you can do interval to find the range, you will do on the both sides. Okay. But if you just want to find on the one side or other side, you can do plus or minus. But when you do plus minus, you get the whole range. Clear, everyone? Right? Non-parametric, here we do not have to remember or memorize the formula. Just remember the parametric test for correlation, we do it when the sample is large, when the sample is greater than 30. Otherwise, we have to use the non-parametric test. One formula that you need to remember in the non-parametric is the degree of freedom for the test of independence. Now, I have told students in the class that it is very unlikely to, just put up a degree of freedom question, but we have seen some of the questions. So for the test of independence, in that we have a formula related to degree of freedom. What is that formula? We have, it is a row minus 1 into column minus 1. Simple. So in case, because we have seen some of the questions where they ask this. So degree of freedom row minus 1 into column minus 1. Remember that formula. Cool, everyone? Yes. Linear regression. In simple linear regression, the most important is the regression equation. So in this case, what is my regression equation? My simple linear regression equation. We are trying to find the value of y, which is dependent on what? Y is dependent on x. So b0 plus b1 into x, plus there is an error. What is error, by the way? Error is nothing but the difference between actual and forecasted value. Actual minus expected value. So whatever the model says, the difference between both is called error. Your focus should be on what is y, what is b0, what is b1, what is x. Y is nothing but the independent variable or dependent variable, guys. Y is dependent variable, dependent on x, which is independent variable. Correct? B0 is called intercept, and B1 is something that we use it so often. Can someone remind me? B1, the slope, which is nothing but the beta. And what is the beta's formula? The beta's formula is covariance over the variance. Now, covariance of what? X and Y over the variance of X. X is independent. The same formula when we do in equity, we also write the same thing, covariance over variance. But the X and Y now becomes what? Stock and market. Let's say stock, I will name as, let's say, name the stock as X, and market divide by the variance of market, because now the market is independent. Same concept, same formula, just the name changes. This is linear regression formula, very important. All right, slope and the equation. Error, as I said, is the difference between observed, that is the actual minus expected value. Assumptions are more important in this topic. In the ANOVA table, two formulas are important. That is about the sum of squares and then about R square. Do I have to memorize the test statistic? No, we don't need to memorize the test statistics. We don't need to memorize these equations also. They just tell you where the log is. Okay, so whether the log is independent or independent, that is what we understand using this, but we don't have to memorize that formula. You need to memorize what? Sum of square total. Sum of square total. Total risk is a combination of two things, systematic and unsystematic. Here we call sum of square regression, sum of square error. Isn't it same as portfolio? Total risk is equal to systematic plus unsystematic. All right. And if I take sum of square regression divided by sum of square total, I will get R square, which is called coefficient of determination. Are you with me? Which is called coefficient of determination. Focus on these two formulas. Other formulas you can go through if you have time. Otherwise, I don't recommend. I recommend these formulas. You want to know standard error of estimate? It is nothing but mean error. Mean error is nothing but standard error divided by n minus k minus 1, that is degree of freedom. In linear regression, what is k? K is the number of variables which are independent, which is always 1. So regression degree of freedom is always 1, and therefore error will be how much? N minus 1 minus 1. It will be always n minus 2. Understood? In linear regression, this will be the case. So if you have standard error of estimate divided by n minus 2, this is the variance, and you do the root of it, it becomes the mean squared errors root, which is standard error estimate. I'm writing it, but I don't expect this, but I will write it down. What is standard error of estimate? What is standard error of estimate that I get? What do we do that? Remember, standard error of estimate is in variance. It's in square terms. Everything that is mentioned here is in square terms. Correct? So this, if I divide it by the degree of freedom, that is n minus k minus 1, and k is always 1 under linear regression. So n minus k minus 1, that is n minus 2. And if I do the root of it, it becomes standard error of estimate. Now, this may sound confusing to many, but that is your standard error of estimate. Always remember, if your R square, should it be higher or lower? For your model to be fit, R square should always be higher. And if your R square is higher, naturally standard error will be lower. Is this clear, everyone in the class? Right? Correct. Big data, there's no formula there in that topic. This is where we complete all the quants related formula. If you have written, great. If you have marked, also no problem. Yes. Any question related to quants, let me know. Anyone has any question about quants? Yes. All good? Perfect. Exponential function, if you want to use exponential function, you will press second ln in your calculator. For any reason that you need to use exponential, we use the return, exponential returns or log normal returns. So let's say, if you remember, we calculated here the log normal returns. So in case if I find the holding period return and then I want to exponential that, so let's say your holding period return is 5%. So you can press 5% plus 1 and then press second ln, right? So what is that used for? That sorry, we pressed ln to find the log normal returns, and second ln is exponential values. We do not need to use exponential values for calculating the returns. But why? Because we have the second icon v function. So here, in order to find the log natural returns, you will simply do 5% plus 1 and just press ln to find the log normal returns. But in case if you want to use exponential, we use second ln. Do I require that to be used? No. However, if you still want to try what is that used for, let's say if I want to find e to the power of 0.05, how do we use this? So we do 0.05 and can you press second ln? Second ln, you will get 1.0513 minus 1. If you do into 100, that will give you your returns, effective returns. Why don't we use this anymore? Because we use the second icon v function. We don't need to use this now because of the second icon v function, where you can get the same job done using 999. Got it? Yes. I just mentioned when to use ln function. In case if they ask you log normal returns, so you will have to use the ln function. Okay, so in the syllabus, we use ln function only. All right. Yes. Clear that ln function you will use in case if you have to find log normal returns. Got it? Yes. Any other questions about quants? Okay. Are you hope you guys are writing the formulas. Okay. I have used the functions that I mentioned you. We are going to be using those functions only. Right? I have a different question. Yes. And yes, if you have a very long question, you can unmute and ask me. Otherwise, the question will get drifted. When do you use which function? Yes, please. 1v? Hello?
Yes.
1v?
So I'm asking for one
Yes.
or
Can you be
lin.
loud? I can't hear you.
So I'm asking for lin, LIN or 1B.
Yeah, see, we use 1v only because what are we calculating here in quants? In quants, we are calculating mean, standard deviation. We use 1v only. You can use lin function if there are two variables and you need to find. So if you have to find covariance or correlation for two securities without probability, then you can use lin. But we don't come across that now in quants. So again, I'll repeat, if you have two securities, X and Y, without probability, then you can use lin function. Got it? But we have covariances with probabilities. So in that case, you will have to individually calculate for X and Y and use the manual way to calculate it. For that, you cannot use lin function. You will have to use 1V only. So throughout the syllabus now, we use 1V function. I'll repeat, if you want to explore for two securities, covariance or correlation without probability, you can use lin function, because in that case, directly you get R, which is correlation. But do we need that right now? No. However, in exam, if you come across that, which I see rare in the questions as per what they have in the LES, but if you want, you can use it. You can use the lin function also. Make sure there's no probability. Only then you can use the lin. Got it? Otherwise, when you press second 7, second 8, your screen should have 1V. If not, keep pressing second enter until you get 1V. Got it? Cool. Yes. Okay. A topic which has enormous amount of ratios, concepts, lengthy. You have sizable readings, one of the highest weightage topics, 12 readings, so many formulas, but not all are formulas. As I said, many of them are ratios. So let us focus on FSA from our notes, everyone. The first reading is where you may not have formulas, but income statement, balance sheet, cash flow, inventory, long-term assets, some of them in long-term equity, taxes. Yes, taxes have so many formula, and ratios, right? All the ratios. Many of the ratios are repeated. Okay, so let's start with directly with reading 2, where we have the most important formula. If anyone can remind me, what is the most important formula in reading number 2? That is a pain for many students in terms of calculation, everyone in the class, that is EPS. EPS. So directly we'll go to the calculation of EPS, earnings per share. Now, in case of EPS, there are two EPS, everyone. Basic and diluted, right? Basic EPS, I'm sure everyone is aware. What is the basic EPS formula? Basic EPS is net income minus preferred dividend divided by weighted average shares outstanding. Now, when I do diluted EPS, also in that, I will write the same things. Net income minus preferred dividend over weighted average shares outstanding. But dilution can be due to three reasons. Everyone, convertible potential dilution can be due to convertible preferred dividends, preferred shares. So what we do, if there's convertible preferred share, we will add back convertible preferred dividend. Guys, I'm writing short form. Okay, if you want to write it properly for your reference, you can use this information from our notes. I'm just writing it because we now can use the short forms, right? Everyone clear with me? Convertible preferred dividend, and in the denominator we will add shares issued to whom? To convertible preferred shareholders. Is this clear? This is in case if there's a convertible preferred shares. If there is convertible debt, then yes, in the denominator we will write shares issued to convertible debt or convertible bonds. In the numerator, instead of preferred dividends, we will write convertible debt interest. But what do we do with this interest? We always do 1 minus t throughout the syllabus. Wherever there is interest, we do always interest 1 minus t, because interest is before tax. Is this clear to the class? And then there is a third option. In case if you have stock options, in the case of stock option, we don't issue them, we don't add all the shares issued, we do the net issued. We write down the net shares issued, or we write down the additional shares issued. So I write down as net shares issued. Now what is net shares issued? Net share issued uses a method called treasury stock method. Do you remember this? What is a treasury stock method? Treasury stock method. This is to evaluate how many shares will be issued for options. Shares issued under the option minus the shares repurchased. And repurchased is based on what? Is based on number of options that will be exercised into the shares, so number of shares into a price divided by some price. Which price? Into which price over which price? Remember, when the option is exercised, this will only happen if the option is exercised. If the option is exercised, the exercise price that is paid by the ones who received options, that is the cash inflow for the company, divided by the average market price of the stock, is the number of shares that the company can repurchase, and the difference between both is called net shares issued. Is this clear to the class? Treasury stock method. Remember the two prices, exercise price and average market price. Don't get confused in the exam with the closing price. We don't use closing price. So only in the case of net share issued, first we will have to identify whether the option is exercised or not. Only if exercised, then there will be extra shares under this method. Is the class clear with this? Basic and diluted. Check, confirm. All right. Now, in this topic, there are ratios also, gross, net, and operating and other margin, which you can either do it here or you can do it later on also. Okay. Everyone knows what is comprehensive income. Comprehensive income is made up of what? Everyone? Comprehensive income. Comprehensive income is made up of two things. Yes, the class should be aware. It is made up of two things: the net income plus OCI. Plus OCI. And remember, OCI has what? OCI has four items: changes in the assumptions due to pension. We learn that in non-current liabilities. So any adjustments in the pension liabilities, any forex gain or loss due to translation. Then there are two things: unrealized gain and loss due to derivatives hedging, and unrealized gain and loss due to FVOCI, available for sale. These four items you should be careful about them because they are in the OCI. They bypass the income statement. Clear? One rule about diluted and basic EPS, guys, everyone should know that the diluted EPS should always be below the basic EPS. If it is above, do we report it? No. In that case, we only report the basic EPS. Clear? I'll repeat, diluted EPS should always be below the basic EPS. I hope that is clear to the class. All right. We can do all of these margins also: gross, operating, pre-tax, all. Whenever they say margins or returns based on sales or margins, we will write it down here. So when it comes to ratios, we will skip at that time. So gross profit, everyone. After that, you have which? Sales minus cost of goods sold is gross profit. Then you have operating profit, which is your EBIT. Then you have pre-tax profit, that is EBT. And then you have net profit, which is net income. All of this divided by sales or revenue, whatever you call sales or revenue, right? That is going to be your margins: cross margin, operating margin, pre-tax margin, net margin. Guys, I would just like to add here, and I know you might find it funny, but when I started CFA, I also had doubt, what is the difference between sales and revenue? They both are the same. So if some students do have doubt and they tell me, sir, it's a silly doubt, I say, no, it's completely okay, because not everyone is from finance, right? So sales, revenue, turnover, top line, whatever you call it, same. Sales, revenue, turnover, top line, it's all the same. Net income, profit after tax, earnings only, whatever you say, it's all same. Cool, everyone? Clear? Perfect. Okay. Now, in the topic of balance sheet, working capital, yes, is important, and the ending retained earnings. This is my favorite. So now I will go to the topic of balance sheet. Okay. In balance sheet. Yes. Balance sheet, everyone. What is the most important thing? First of all, working capital. You will see that coming up across it is working capital is current asset minus current liabilities. All right. Quick assets. Quick assets, guys, I will write down quick asset is current asset minus inventory and minus prepaid expenses. You can write down even though it may rarely be put up, but still prepaid expenses. Clear, everyone? Ending retained earnings. Yes, very important. Ending retained earning is beginning retained earnings. And what is the only difference between both? Beginning and ending is due to two things: net income and dividends. So, dividends which are paid, right? Dividend paid. That is the difference between both ending retained earnings, beginning retained earnings, net income, and dividend. Keep this in mind because, of course, not only in level 1, in level 2 also it's needed, but this equation will help you understand the difference between ending and beginning retained earnings. Then the topic has formula about goodwill. What is goodwill? Goodwill is the additional amount paid, that is the purchase price that you paid. Now, if you have paid cash, you will use cash. If you have paid, let's say cash means, let's say you paid 1 million shareholders $10. So 1 million into 10, that is the purchase price. All right. Minus, we write fair value of net assets. Fair value of net assets of the company that you are acquiring. Okay. Now, there is one more component in the calculation of goodwill: fair value of what exactly? So we say fair value of net asset. And what is net asset? Total assets minus total liabilities. I will write down for your reference what is net asset. Net asset is nothing but total assets minus total liabilities, which is nothing but total equity, but based on fair market value. On the balance sheet, we do it on based on book value. So here we do based on fair market value. Remember, this is which goodwill? This is accounting goodwill or economic goodwill? Accounting goodwill. We only report accounting goodwill. We never report economic goodwill. All right, everyone. Now, there is another component for your formality here, which you can skip writing in case if you don't want. That is goodwill purchase price minus fair value of net asset acquired plus fair market value of identifiable intangibles previously not recognized. Now, the third component that you see is rarely put up, but in case if you want for formality, you can write. Otherwise, I prefer this is what you should remember. Clear, everyone? Right? If you want, you can write it, but I prefer this only. This is what should be tested. Fair market value of identifiable intangible assets previously not recognized. Now that is a bit complicated. It is rarely put up. If you want, you can write it. Okay. About goodwill. This is accounting goodwill. Remember, we don't recognize the economic goodwill. In this topic, we have some ratios, and that's why I put up the current and quick asset. So three ratios: current ratio, quick ratio, and cash ratio. All of three have one thing in the denominator. This is how you remember the ratio. What they have common in the denominator? They all have current liabilities. Current liabilities, everyone, right? And in the numerator, current ratio has current asset. Higher the ratio, better it is. It should be greater than 1 also. Quick asset. We just discussed what is quick asset. Current asset, ignore what? Stock, that is inventory and prepaid expense. All right. And in cash ratio, we only take the cash and equivalents. So here, interesting thing. What are the cash and equivalents? We say cash and short-term marketable instruments or short-term market investments. So whenever they say short-term investments, we will consider them with the cash. You may see that written cash and equivalents, cash and short-term investments. Those are my liquid investments. The strictest of all is cash ratio. Higher the ratio, the better it is. All of these are called, they are related to short-term survival of the company. So they all are called liquidity or solvency ratio. They are all called liquidity. It tells me whether the company will survive in the short run or not. Liquidity ratios, higher the ratio, better it is. Solvency ratios are long-term survival of the company, which is based on long-term source of funds, that is debt and equity. So in that case, the name itself is the formula. What are the solvency ratios? Long-term debt to equity or simple debt to equity. Okay. Debt to equity. Now, remember, if they say long-term debt, use long-term debt. If they say debt, use total debt. So I will use long-term debt to equity. Simple debt to equity ratio, you use debt to equity ratio in multiple places. Then there is debt ratio only. Now there are several ratios you will come across in fixed income, because in fixed income we check the company's leverage. So in that we use debt to EBITDA ratio also, right? All of these ratios, the name itself is the answer. Now debt ratio is how much is your debt over the total assets of the company. So out of the total assets, how much is funded by debt? Both of the ratio, lower the ratio, the better it is. One of my favorite ratio is financial leverage ratio. Financial leverage ratio. And remember, financial leverage ratio has a shortcut also. But first, I will tell you what is a financial leverage ratio. It is total asset over total equity. This ratio also transforms, please write it down, it also transforms into 1 plus debt equity ratio. Yes, this ratio also transforms into 1 plus debt equity ratio. This ratio is used where? In ROE DuPont. In ROE DuPont, the last component is financial leverage. Remember this when we use ROE DuPont. Clear with all the balance sheet related ratios? Check, confirm. Good, everyone? Yes. Now I will focus on the most important, that is cash flow. How many of you are struggling with operating cash flow calculation? Anyone here? Or everyone knows it? Anyone? Operating cash flow, easy, difficult? We will calculate operating cash flow. For operating cash flow, we will use indirect method and direct method. So for indirect method, it starts with one thing, I don't know why. Yeah, it starts with what? It starts with net income plus the non-cash charges. You add all the non-cash charges, depreciation, amortization, and then you will subtract any gain or add back any loss which is non-operating. Non-operating. The best example of this is gain and loss from sale of assets. Gain and loss from sale of assets. Those are non-operating, we exclude them. Now, by the way, this is not your official formula of CFA Institute. This is what I use it for my reference so that I don't miss out anything. In this, then I will add and subtract all about working capital, because CFO is all about working capital. So what we adjust, we add what? Current asset and current liability changes. So any increase or decrease in current asset or current liability, those are my operating assets. So remember, increase in current asset or decrease in current liability, it's a cash outflow. But decrease of current asset or increase of current liability, increase or decrease means from last year, that's a cash inflow. Is everyone aware about this now? Is this clear to the class? Anyone has any concern here? That's going to be my operating cash flow indirect method, highly testable than the direct method. All right. I will do the direct cash flow method in the next page. But if it's investing cash flow, guys, investing cash flow, and if it's financing cash flow, what are the components? Let's write it down here. Investing cash flow, you will only focus on purchase and sale. Sale and purchase of what? Sale and purchase of PPE or long-term assets. Long-term assets, non-current assets, whatever you say, that is sale and purchase of PPE, you will focus. So if there's a sale, cash inflow. If there's a purchase, that's a cash outflow. In CFF, you will focus on three things: equity, debt, and dividend. Dividend is a part of equity only. But any changes in debt, any changes in equity, and dividend paid. I write dividend paid separately, even though it's a part of equity, because dividend paid is always minus, changes in debt and equity are plus. Remember, when I say change in debt and change in equity means what exactly? So when I say change in debt, guys, understand change in debt is inflow minus outflow. What is inflow? Inflow is inflow is inflow is borrowings, right? Inflow is borrowings. And outflow is when you repay. So very good. We use the borrowings minus repayment. In equity, we instead of borrowing, we say equity issued minus repurchased. Issued minus repurchase. Issued minus repurchase. Clear? Dividend paid is always minus, because dividend paid is commonly treated under IFRS and US GAAP as CFF outflow. Dividend paid is commonly treated as CFF outflow. All right. This put together will be my CFF. So if you notice, for operating cash flow, I look at operating assets, current asset, current liability. For CFI, I will look in the balance sheet as the non-current assets. And for CFF, I will look at the financing, that is non-current liabilities, debt and equity. All three clear? They are much better written in my notes, so you can check it out. The way we've written for indirect, focus here, indirect one, investing, and then for financing. This I have put up extra, you may not require it. Okay. Now, should we focus on the complicated one, that is the direct cash flow method? Everyone? Yes, CFO direct method. Now, in this, there's a high chance that they probably might give you the individual component, right? We break down this into what? We break down into cash collected from customers, and then everything paid, cash paid to suppliers, cash paid for operating expense, cash paid for operating expense like salary or rent. In exam, they may put actual names, salary or rent instead of OPEX. Cash paid for interest expense, and cash paid for taxes. Cash paid for taxes. All of this are cash outflows except the first one, that is cash collected from customers. Now, students get worried because they think, oh, it's a huge thing and do I have to memorize it? No, not necessarily. They may ask you a component. So it's same order as your income statement. Cash collected from customer will start with revenue or sales, which is plus. Cash paid to supplier starts with cost of goods sold. Cash paid for operating expense starts with operating expense. Cash paid for interest starts with interest expense. Cash paid for taxes starts with tax expense. All of these items are in the income statement, correct, everyone? But on the balance sheet, you will also check if there is any outstanding paid or accrued. So we do what? Now, again, these are my ways of writing there's no formula as such, but I hope those who've seen my lectures, they know through this way. Has it helped you to solve the questions, this method, what I'm writing? Because it's not an official formula. I hope this has helped you get rid of all questions. Pick up any questions. This process you do, it's much easier, right? So cash collected from customer, revenue, and what is the other areas where there is outstanding about the customer? That is receivables and unearned revenue. So we do what? Changes in accounts receivable. Now, wherever I'm writing balance sheet, it is all change, right? Balance sheet changes in accounts receivable and changes in unearned revenue. Now, guys, I'm writing short form here. The detail is mentioned here, right? You can check it out properly. And the reason plus minus I'm writing, many people know why, because increase and decrease both are not plus and minus there. It depends. And we use the common sense here. Increase in current asset, it's a cash outflow, minus. Decrease in current liability means you paid, minus. So we use that. It takes time. Therefore, this is my mathematical way of solving finance or accounts, right? I'm poor in accounts. So this format I invented just to make sure that I don't make mistake. And I think maths helps if you're weaker in finance. Okay. Cash paid to supplier, it's changes in where exactly? Cash paid to supplier is changes in accounts payable and changes in inventory. Inventory is in current assets. So plus and minus. For OPEX, any accrued expenses. So changes in expenses accrued. Accrued means due but not paid. There is a component for formality I'm writing, but it may not be tested up in exam, is prepaid expense. So if there is any change in prepaid expense, and I'm sure by now when you're doing formula, you must have done so many questions. Rarely you must have seen prepaid expenses. Okay. But prepaid means you paid in advance, so that's a current asset. Cash paid for interest expense is changes in interest expense payable. So if there is any interest expense payable, interest expense payable, right, that will also be adjusted in the cash paid for interest. Now, I think I've got my revised book is not visible here, but there is tax related also, which is missed out here. You can either write it down here or here. For tax, very interesting. What do? We do changes in taxes payable, correct? Changes in taxes payable. But remember, for tax, there is also an adjustment which is not in current asset and current liabilities. What? Changes in DTA or changes in DTL. Yes, this DTA DTL, you may not have seen that in the questions, right? By now, you must have seen many questions. You may have rarely come across this, but in case if it comes across, you will have to adjust the DTA, deferred tax asset and deferred tax liability changes also. The rule is same. If there is increase in current asset, it's a cash outflow. If there's an increase in current liability, it's a cash inflow. So same rule applies for DTA, DTL also. In exam, be ready that either of the component may be tested, but also be ready that if they ask you the entire component, which I rarely expect because it's so time consuming and they know this constraint of times. So guys, cash collected from customer is the only inflow. Everything else is outflow, but don't depend on plus and minus, depend on the logic. Both direct and indirect method will give you the same CFO or different CFO, everyone. It will give you the same CFO. All right. One more thing I would like to add here that, guys, if I have beginning cash and bank balance and ending cash and bank balance, what is the difference between both due to beginning and ending cash and bank balance? Is due to nothing but CFO plus CFI plus CFF. So guys, any change in the beginning and ending is due to the three CFO components. So that should always match, isn't it? If it's not matching, there's something error. So the difference between beginning and ending cash balance is due to CFO, CFI, CFF. Cool. I know my handwriting is messed up, but it's okay, right? Notes are better, and your book should also be messed up by writing. That's the hard work on the ground. Cool. Next, we will now focus on free cash flow. This reading is an extension of cash flow. So in reading number 5, we use free cash flow. There are two components, FCFF and FCFE. But before that, I will use the simplest form of operating cash flow, assuming there is no operating. For free cash flow, we don't assume any operating cash, non-operating items. So simplest way of operating cash flow is net income plus non-cash like depreciation minus any changes in working capital. Remember this. Why? Because in FCFF and FCFE, in both cases, you have CFO minus working capital is already adjusted. What else do I need to adjust? Fixed capital investment. That is the common thing for both. In FCFF, it is for the entire firm. So what I will do, I have deducted the interest in net income. I will add back the interest 1 minus T. Is everyone with me on this? Interest into 1 minus T, we will add back. Clear? Understood why? Because we had subtracted it. In FCFE, you don't need to add back interest 1 minus T, but you will adjust the net borrowings. Net borrowing is nothing but borrowing minus repayment. Understand, net borrowing is nothing but borrowing minus repayment. If the borrowing is more, this number will be plus. If the repayment is more, this number will be negative. Is this clear to the class? Two ratios which are related to cash flow, which is very important. Reinvestment ratio. And then the second ratio which you should know is investing and financing ratio. Investing and financing ratio. Now, why these two ratios are important? Because of the fact that they are related to cash flows, and here we always measure them against the cash flow, and the most sustainable cash flow is operating cash flow. Investing and financing are not sustainable. So operating cash flow, we are measuring whether the operating cash flow is enough to fund my long-term assets. So do I have enough for paying? So cash paid for non-current assets or long-term assets. Long-term asset, that is nothing but my CFI outflow, right? Cash flow from investment outflow. So do I have enough CFO for that? And investing and financing. So here I consider my cash outflow for not only long-term assets, but also my financing. So cash outflow for investing and financing. So basically, do you have enough operating cash flow for CFI and CFF payoff? CFI payoff means capex and CFF means repayment. So should this ratio be higher or lower everyone in the class? This ratio, higher the ratio, the more sustainable your operating cash flows are. Your cash flows are enough to repay. Understood everyone? These two ratios. Check clear. All right. Yes. So, guys, I divide the FSA into two parts. One is the financial statement, balance sheet, income statement, cash flow statements, including free cash flow. And then we do the ratios, all the ratios that you come across, right? Before we go to inventory, another topic. All right. So, my suggestion would be, can you go to directly to the ratios topic, everyone? And ratios is financial analysis technique. Okay, in this, there is no formula of common size, but remember for common size, for income statement, we convert everything as percentage of total revenue. For balance sheet, percentage of total assets. For cash flow, we convert everything as a percentage of revenue, or individually inflow and outflow, we divide by their total inflow and total outflow. There's no formula here, but it's for your reference that you should know. In this, these ratios, which are so critical and repetitively tested, everyone, inventory turnover, receivables turnover, payables turnover, working capital, fixed capital turnover. Now, guys, whenever you see turnover, the numerator is sales or component of income statement divide by the balance sheet. And every time you have balance sheet, we take the average because sales is for the whole year. So, what is most important in all the ratios? I'm now focusing on the ratios. You can write down all the ratios, but I don't want you to just write down unnecessarily. So remember the turnover ratio. The most important is inventory turnover ratio, receivables turnover ratio, and payables turnover ratio. Payables turnover ratio. And the inverse of that in days will be days of inventory, days of sales outstanding, and days of payables. So very critical, these ratios, because the inverse of that will give me days. So first of all, inventory turnover is inventories are measured at cost. Receivables are for credit sales and payables are due to credit purchases. All right, everyone. Now, remember in the denominator what we write. In the denominator, we write what the name is. That is average of inventory, average of receivables, and average of payables. We always take average, but for your exam, if you don't have average, you can take whatever the closing value you have. Inverse of this ratio into 365 will give me what? Will give me the days. Inventory turnover, receivables turnover, payables turnover. And now I will connect these days also. So if I say days of inventory plus days of sales outstanding minus days of payable, what is this called as? I'm very interested if you are aware. What is this called as? Everyone in the class. It is called as net operating cycle or cash convergence cycle. Don't forget this. It is going to be repeated in corporate issuers. Cash convergence cycle in corporate issuer, the topic of working capital. This is repeated and we want this ratio to be lower. Is this clear? This turnover ratio? Rest any turnover ratio, working capital, asset turnover, I will write down those also, but these are the most critical ones. For example, if they say working capital, fixed asset, total asset turnover, the name itself is the formula. The name itself is the formula. In all these cases, we are trying to measure the company's efficiency. So we do what? Sales. All of this we are measuring with sales. So how much of working capital was used to generate the sales? So this is divided by average working capital, average fixed assets, average total asset. The name itself is the answer. Higher the ratio, the better it is. Is this clear to the class? These ratios, these are called activity ratios, also called efficiency ratios, except the payables turnover, higher the ratios, the better it is. Okay. Liquidity ratio, we've covered all of the liquidity ratio except one defensive interval, which we will write down. What is defensive interval ratio? Everyone, defensive interval ratio. Defensive interval ratio. Many people say me, Kunal, you're writing so many formulas, but I don't see that in the questions. I agree with them, but yeah, I find this important. So defensive interval ratio tells you the answer in days. It tells you the answer in days. So we take care of all the operating cash flow daily. So we calculate the daily cash expense. So whatever is my daily cash expenditure. So let's say your cash expenditure divided by 365. In the numerator, we take all the liquid assets. So that is cash, short-term investments, and receivables. So we take cash, all short-term investments, and receivable, accounts receivable. So if we, based on that liquid funds, how many days of expenses I can cover, that is called defensive interval ratio. This should not be too high, too low. All of the solvency ratio we have covered, right, in the balance sheet. Profitability is also we've covered with respect to sales. Coverage ratio and profitability with respect to investment are essential. In this case, operating ROA is not that essential. Return on common equity is also not that essential. But interest coverage and fixed charge coverage, let's do that. Interest coverage ratio and fixed charge coverage ratio. In fixed income, you do debt service coverage ratio. Okay. Debt service coverage ratio. Same. These are ratios looked by banks. So interest coverage ratio, interest is paid from EBIT over interest. And the only difference between interest coverage and fixed charge coverage is lease. So if in the same ratio, if I add my lease rentals that we have to pay, right, then it becomes fixed charge coverage ratio. Yes, everyone? Clear with this? Now, returns with respect to sales, profitability with respect to sales, we've covered. Profitability with respect to investment, you should know ROE, ROA. These are the two important ones that you should know, right? ROE and ROA. In both cases, please note it is net income over the name itself. What is the name? Return on equity. What is it? Total equity. So you will take average equity, average total assets. Officially, it is average, but you can take whatever the value you have. You have the ending value, you can take that as well. Is this clear, everyone, in the class? There are other formulas also. You can check it. Return on total capital considers the total investment. So just for formality, I'm writing return on total capital or return on capital employed. It actually takes all the capital. So then all the capital means it takes debt and equity both. And who's paid first? Debt. So we pay the debt from EBIT. So instead of net income, it's EBIT. So depending on who you're calculating the return, that is on the numerator. These are three important formulas as per me. Okay. Honestly, it is ROE and ROA only. And in that, let us break down ROE into DuPont. Are you ready for it? So net income over average equity. First, we'll break down into 2 point. That is net income over total assets and total assets over total equity. What is this called? Net income over total asset is asset turnover, and total asset over total equity is financial leverage. This is what I'm doing, the DuPont. DuPont ROE is repeated twice in the syllabus. So this is nothing but ROA into financial leverage, correct? Everyone, you can break down that further into 3 point ROA. So 3 point is ROE. That is what? Net income over total as net income over, we will do margin. So net income over sales, sales over total assets, and total assets over total equity. This is nothing but my net profit margin times asset turnover times financial leverage. I have actually broken down further also. That is, we have broken down the net income margin or net profit margin into tax burden, interest burden, and operating margin. So what is tax burden? Tax burden is nothing but, yes, it is net income over EBT. EBT over EBIT is interest burden, and EBIT over sales is operating margin. You can break it down into further into this also. This will become your 5 point ROE. This is 3 point ROE. Actually, 3 point ROE is sufficient. You must have seen many questions but not 5 point rarely, but we do it all. It's like, you know what, we are ready for the battle. Let it come. Understood, everyone? Clear? DuPont by the chemical giant. Everyone clear? Right? Then there are other ratios in this topic also. These are all equity related ratios. You can skip them now and do it with equity. These are all the ratios which you may not need, but it's very simple. PE, price earning, price to book value, price to cash flow. We will not focus on them right now. Why? Because they are also repeated in equity with justified. We'll rather do the justified one. Payout ratio, retention, and growth, that is important because that is repeated multiple times. So what is dividend payout ratio, everyone? What is retention ratio? And what is growth, sustainable growth, everyone? Dividend payout ratio is dividend per share, yes, dividend per share over earnings per share. That is your dividend payout ratio. Retention ratio is 1 minus payout ratio. So it is 1 minus the dividend payout ratio. That is your retention ratio. And growth is nothing but retention ratio into your ROE, which you can break down into DuPont. Is this clear to the class? Everyone, dividend payout, retention into growth. One small formula I will tell you, that even though it's not needed here, P ratio into EPS will give you the market price or intrinsic value. We rather use it for intrinsic value. Again, we don't need that right now, but we will utilize that in equity just for your reference. Your focus should be on the retention ratio into ROE, that is growth rate. Correct. CV, guys, CV is coefficient of variation. We've already done that. So if they ask you CV for any of the financial numbers, whether it's revenue, operating income, or net income, it's the same formula. CV, coefficient of variation. All right, everyone, clear? Yes, that's it. Is everyone done, understood with the first phase of your FSA, which is so critical? Because in the first phase, as I say, even when you are doing FSA with me, I say this is so important. You spend so much of time into this, even though it is very easy, but this makes your foundation so strong. All right, everyone. Now, in this section, you will see many of the formulas repeated. They are related to ratio, financial statement modeling. Doesn't have a formula, right? But inventory, long-term asset, long-term liability, and taxes, yes, there are some formulas. FSA is the biggest of all. Okay. So we'll now focus on inventory. Correct, everyone? So now moving towards inventory. Now in inventory topic, we have these readings where this may have a lot of formulas which are similar to what we already saw, but it's not about the ratios here. It's beyond the ratios. What is unique here? So you will see a lot of ratios which are similar, but what is unique here in this topic is about the LIFO reserve. LIFO reserve, very important. You have to, LIFO liquidation, you have to readjust the profit. No calculation there, but inventory measurement is something that worries student. Inventory measurement, that is what we will understand. So what is inventory measurement? There are two approaches to measure the inventory using IFRS and US GAAP. Basically, it's not IFRS and US GAAP. It is about LIFO and non-LIFO companies. Now, you are aware that non-LIFO companies are all IFRS companies and all US GAAP companies who don't use LIFO. So I will say LIFO and non-LIFO companies. Non-LIFO companies and LIFO companies, we are discussing on inventory measurement. You can write down this. By the way, all these formulas that you write down, you can do like me. I used to print them and stick it on my wall. So whenever I wake up, I see formulas. So I know this is exaggerating in today's era, but this is how we studied. So we are learning inventory measurement. All right. In this, inventory measurement, we have to discuss how is the inventory recorded. So I will write LIFO and non-LIFO. All right, everyone. So we record inventory on the balance sheet at everyone lower of minimum of what? Minimum of something. Lower of cost. In IFRS, we say lower of cost or NRV. In US GAAP or basically in LIFO, right, we use lower of cost or we write market or replacement cost. Either cost or market or replacement cost. Now see, I've written lower of, means whichever is lower will become the inventory which is reported on the balance sheet. So I'll write on the balance sheet, what do we report? We report inventory as lower of cost or something. In non-LIFO, that is majorly US GAAP, non-LIFO and IFRS, all companies, because IFRS doesn't allow you LIFO, we measure at lower of cost or NRV. Now, what is NRV is the question mark. Net realizable value. And then we will discuss what about replacement cost. So I'm talking purely from the exam point of view. NRV, net realizable value, is forecasted selling price minus selling cost minus completion cost. So NRV is selling price minus selling cost. This is most commonly asked. And then there is an additional cost also in case if they put up, that is completion cost. But selling price and selling cost, that net difference between both is your NRV. For market replacement cost, now that number will be provided to you in the question, but you have to check whether that number is within the upper and lower limit. Now, what is upper limit and what is lower limit? That you will have to check. You can only take maximum and minimum of upper and lower limit. Upper limit is equal to NRV, ever in the class, and lower limit is NRV minus, we write normal profit margin, which they will provide you. What is normal profit margin? This is unique thing about the measurement of inventory on the balance sheet. Now remember, on the balance sheet, if the value of the inventory falls below cost, if the value of inventory falls below cost, then we recognize the loss in the income statement. So any difference between the original cost and NRV, original cost and the market or replacement cost, that is recorded as, what do we call it as? Write down loss, every in the class. So that is going to be my write down loss recorded in the income statement. Remember, write down is non-cash, so there is no impact in the cash flow statement. And just remember, IFRS and US GAAP. IFRS allows reversal or not? Allows reversal only maximum till the cost, right? But US GAAP, no reversal. Means if there is a gain in future, it is not allowed. To maximum, how much? Original cost. Is this clear to the class? Everyone with me on this? What is the impact on balance sheet, income statement, cash flow? There is no impact on cash flow. Is the class clear with this? Check and confirm. Confirm me, because this is the only thing that you need to remember from this topic. All good, everyone? Yes. Now, rest all are ratios. So we are not discussing about the ratios, which we already covered, right? Then in the long-term asset, also like inventory measurement, here we have depreciation and goodwill impairment. But related to depreciation, there are several ratios. So now we will discuss on long-lived asset or non-current asset, whatever you call the topic, or long fixed assets and intangible assets. So you have non-current asset as PPE, intangibles, financials, in securities which you invest, and DTA. They are all part of non-current asset. Now, in this case, depreciation, even though may not be tested, but SLM depreciation, everyone knows what is the simple formula. It is historical cost minus what? Accumulated depreciation. Accumulated depreciation is a depreciation till date divided by the estimated salvage or estimated residual value. You say residual value or salvage, it is the same thing. Residual value or salvage. Remember, of these, two things are estimated. That is, what are the two things estimated, guys? Right? Depreciation, historical cost minus accumulated depreciation. Divide. What did I do? I just did a mistake. Sorry. Historical cost minus. Sorry, my mistake. Historical cost minus salvage divided by useful life. Sorry. I'm thinking two formulas together. Historical cost minus estimated salvage divided by useful life. This happens when you're writing one and thinking of the next formula. Useful life. What are the two things estimated here, guys? The two things, historical cost minus estimated salvage is also estimated, and useful life is also estimated. That is in the control of management. All right, everyone. Now, based on this, based on SLM concept, we have three formulas: total useful life, correct? Then there is something called average age of the asset and remaining useful life. Remaining useful life. First of all, understand the fact that the historical cost minus if I do the accumulated depreciation till date, that is called my gross PPE. So we say gross PPE. What is gross PPE? Is nothing but the, everyone, gross PPE and net PPE. First, we will discuss that also. What is gross and net PPE? And what is accumulated depreciation? All three, let us discuss that. Gross, net, and accumulated depreciation. So guys, gross PPE is nothing but the original price at which you bought the asset. So what is my gross? It is nothing but my original cost or historical cost. From that, if I subtract the accumulated depreciation, that is what we call as net PPE. Net PPE is also called carrying value. Are you with me? Net PP is also called carrying value. Please use out these names, everyone in the class. So all of this is divided by what? The depreciation expense. The depreciation expense. So if I divide all of this by depreciation expense as per the income statement, the depreciation expense for the year ended, right? All of that will give me what? Total useful life. How much is the life of the asset? Average age. How much of the life has passed? And the balance is remaining useful life. Is this clear, everyone? Just remember the SLM formula. Double declining. There is a formula for double declining. Do we have to remember that formula? I will write down the official formula, but in the class for double declining, we do not use this formula. The official formula is 2 for making it double over useful life, and we multiply that with the carrying value. Now, what is carrying value? Original cost minus accumulated depreciation. This is the carrying value. This is the official formula, but we don't use it. Why we don't use it? Because we use the calculator function. Rarely you must have seen any question related to depreciation, but we use the depreciation function of second 4, and I would suggest everyone to use this only. Understood, everyone? Clear? In that you get all the values, which year depreciation you want, which year's carrying value you want. All good, everyone? Now, carrying value. Again, carrying value. In last three formulas, depreciation is annual depreciation. Yes, depreciation expense for the year. That is what we write. Depreciation expense is annual. We use depreciation expense in the denominator. Yes, correct. In the previous formulas. Got it? Yes. Okay. Now, guys, the carrying value. Please remember carrying value is historical cost minus accumulated depreciation. That is the carrying value. So, based on that carrying value comparison, we will now understand. We understood write down. Similarly, we will now understand impairment. Impairment, everyone, very important, highly testable. In impairment, the condition difference is between IFRS and US GAAP. Yes, IFRS and US GAAP. So we will understand what is the IFRS condition, what is the US GAAP. Everyone knows how important this is, right? So first thing, there is a condition for impairment, whether IFRS or US GAAP, you always compare the carrying value. That is what I just discussed, the historical cost minus accumulated depreciation with something. So we compare the carrying value, guys. I'm writing carrying value short form. Carrying value of asset, carrying value of asset. We compare that with something which we call here as recoverable amount. And in US GAAP, we use another thing for testing. It's a two-step process in US GAAP. In US GAAP, actually, it is step one and step two. Step one and step two. And why they both are different in US GAAP compared to IFRS. In IFRS, it is simple. So in IFRS, whenever the carrying value is greater than recoverable amount, what is recoverable amount? We will discuss. Then the difference between carrying value and recoverable amount is considered my impairment loss, which is recognized in the income statement. And in the future, if there is reversal, it is allowed only till previous loss. Only till previous loss. I hope for IFRS it is clear that it is the difference between the carrying value and the recoverable amount. That is your impairment loss recognized in the income statement. If there is a future reversal, yes, it is allowed only till previous loss. Now, only question that student have is what about recoverable amount? What is recoverable amount? So recoverable amount is a condition. It is higher of two, means maximization of two things. What we write down as value in use and similar to NRV, that is, we write fair value minus selling cost. So we write two things, value in use. Value in use is one thing. And the second thing we say fair value minus selling cost. Now this is the only complicated part. So higher of both of this will be considered your recoverable amount. Compare with the carrying value. If the carrying value is higher, that's an impairment loss recognized in the income statement. Your balance sheet value will go down. Is there a cash flow impact? Is there a cash flow impact? Check and confirm. Let me know. No cash flow, right? Because it is non-cash. In US GAAP, there are two things. We do the carrying value is compared for testing whether it is impairment or not. The condition is that the carrying value should be greater than undiscounted future cash flow, which they will provide. But for measuring the impairment loss, which is recognized in the income statement, for that impairment loss, it is the difference between the carrying value and not undiscounted future cash flow. This is where students get confused, but it is between the fair value. And is the reversal allowed? Reversal is not allowed. Everyone clear? Understood this? Check and confirm. Okay. This impairment is much better written in my notes. You can check out that what the way and how it is written in detail. If you want to analyze, this is what we are just writing for our reference, for a quick recovery. Clear, everyone? Well, this is the formula in long-lived asset. In long-term liability, is there a formula in long-term liability? Do we calculate anything in long-term liability? If you recollect anything in long-term liability, well, in long-term liability, we calculate one thing is the funded status of the plan. So there's no formula as such apart from the funded status. So what is the funded status of the plan, everyone? Funded status means this is about pension plan DB. So funded status compares two things of a DB plan. What are the two things? Yes, see, you have a question of held for sale is allowed under. Yes, in my notes, I've written in depth that if it is held for sale, generally we have held for use, it is not allowed for held for sale. You can go into that macro level, but rarely testable. Yes, for held for sale, allowed, but again, the condition is same. If you want to understand, one more step. Naturally, should what will you naturally have is held for use, which is not allowed. I tell students don't get confused. By default, remember it is not allowed. Okay. But in case this is exceptional, if an item is held for sale, but don't confuse yourself. Generally, freeze in your head, it is not allowed. Okay. Only if it is held for sale, any asset, which is generally you do when you spin off or you split off the company in that case, right? Then in that case, it may be allowed, but again, the condition is same. I'll repeat, those students who are confused, don't worry about it, ignore it. Just remember, US gap like inventory write down, reversal is not allowed. Okay, clear? All right. What is funded status? Come on, guys. Let me know what's the funded status. Funded status is difference between what? Difference between the asset and liability under the DB plan. Can someone tell me? It is the difference between the plan assets, which is your investments, minus the liability. Remember, in the pension, what is the liability? We call the liability as plan benefit obligation or projected benefit obligation. PBO is the liability that you have to pay to the pension, that is accrued till date. Now, if the plan assets are greater than the liability, or if they are below the liability, if they are greater, we call it as overfunded. Guys, online guys, are you there? You are supposed to discuss with me, write it. Underfunded, everyone, right? Underfunded and overfunded. Remember, on the balance sheet, we either record net plan assets or net plan liabilities. We don't record both. All right, remember this. Now, there are no other formula in this topic as such, but just for your reference, again, it's not something that you should probably memorize, but for the share-based compensation, share-based compensation, this is something, in level 2 you will have a calculation related stuff about share-based compensation also. Just that when you calculate the fair value of compensation, so whatever compensation is given to the employees, the fair value of that compensation is nothing but the stock price on the grant date. Remember, stock price on the grant date into number of shares, granted. Now, if you remember, this formula is nothing but like a market cap. What is market cap? Market cap is nothing but share price, current market price into number of shares, right? That is market cap, correct? So we are doing market cap only, but for the shares that we are giving. I'll repeat, don't get worried about the formula. It is market cap, but for the shares that we are giving. This formula may not be needed at all, but I'm just telling you that, sometimes something comes out of the box. You'll be like, what this came, where did this come from? I have no idea. No, it's simple compensation amount. So if I give you 100 shares at $10 market value, that means I gave you $1,000, right? Simple. So in case if they ask you what is the fair value of compensation, just take market price into number of shares given. Cool, everyone? Right? Okay. Yes. Now comes my favorite topic, taxes. Taxes. Yes. Everyone. I just discussed in balance sheet case, what happens? Hello? What happens in the case of balance sheet? Impairment. Impairment is a what? Loss, right? Same like write down. when in write down, what happens on the balance sheet? The value goes down if there's a write down, and the loss is reported in the income statement. Same for impairment. What happens in impairment? The balance sheet value of asset goes down, loss is recognized in the income statement. Is there a cash flow impact for write down or impairment? No. Clear? Impact on the balance sheet, income statement, cash flow for three things is same. You know three things. Which three things is same? Impairment, write down, and valuation allowance, which I will discuss now. The impact on the balance sheet, income statement, and cash flow for all three is same. Impairment, write down, valuation allowance will reduce the asset value on the balance sheet. The loss will be reported in the income statement, whatever is the fall in the value, and no cash flow impact. All three, connect the dots. Got it? Everyone? Understood? Yes. Now we are going to discuss taxes. And in taxes, since you asked me this question, I hope you've understood about valuation allowance. Also, the impact will be same. Now, in taxes, you understand that there are financial and tax reporting, correct? The balance sheet value of asset and liability as per financial report is called carrying value. As per the tax reporting, we call it as tax base. We call it as what? Tax base. Now that is very important. Where is it? Yes. Income tax expense and income tax is payable. Those are the names as per financial and tax reporting. All right. Remember the condition for DTA and DTL that you should know. What will create a DTA and what will create a DTL? So we compare two things. We compare income tax expense and income taxes payable. So I compare what? Taxes payable, which is as per the tax reporting. Everyone, taxes payable as per the tax reporting, and income tax expense, which is as per the financial reporting. Now tell me, everyone, when it is a DTA. Remember, if you watch my lectures or if you've been with me in the lectures, I use a four-step process that if today the taxes payable are more, I paid more taxes, it's like karma. In the future, I will pay less. It's a benefit. So it's a DT. DT, come on, complete the sentence. It's a DTA, isn't it? So if the taxes payable are more than income tax expense, it's a DTA. If today I paid less taxes, in the future I'll pay more. It's a liability because it's a loss. That's a DTL. I call remembering this like karma. Okay, easy. I hope you understand it. DT and DTL both are where? DT and DTL are both on the balance sheet under non-current. For US GAAP, of course, you can have some current also, which is due in the current year, but otherwise it is non-current. The two other formula that you are very much required is the effective tax rate and the cash tax rate. Effective tax rate and cash tax rate. Now, under both, we are comparing what is the income tax expense to what? To something that is a pre-tax income. So what is common under both the formulas is the denominator. Is the denominator. And what is the denominator? Pre-tax income. Pre-tax income, which is nothing but EBT. So that is common. Pre-tax income, which is nothing but EBT under both the cases. Everyone with me on this? Now the numerator is what the formula is. If you notice, what is the formula about? Effective tax rate. So in the numerator, I will take income tax expense. And here in the denominator, here in the cash tax rate, I will take the cash tax outflow or cash taxes paid. There's a difference between both. Of this, effective tax rate is very important for you because we compare two things: effective tax rate with statutory tax rate. And if they both do not match, we call it as permanent difference. Everyone, very good. Permanent difference. Remember, only temporary difference is recorded as DTA or DTL. If it is permanent difference, no DTA or DTL will be recorded. Understood, everyone? Clear? Then there is a formula related to what? Related to changes in tax. So what will happen to new DT and DTL? I will write down that. If there is a change in tax, so what will be my new DTA or even DTL? The formula is the same. Well, you will take the older value of DT and DTL. You will take the older value of DTA or DTL, whichever is provided to you, and multiply with the ratio of new tax rate to old tax rate. So multiply with the ratio of new tax rate, I will call new and old. Of course, as the tax increases, so if the tax has increased, DTA and DTL both will increase. Okay, and if the tax rate decreases, both will decrease, vice versa, right? Everyone in the class? Correct. Now, that also means that the only difference between the two tax numbers, that is income taxes payable and income tax expense, is due to, so income tax expense, this formula is very important, and income taxes payable, which is as per tax reporting. What is the difference between the two? Due to DTA and DTL changes on the balance sheet, due to the changes in DTL and changes in DTA on the balance sheet. Now remember, official in the formula we write plus and minus, means if the liability increases, see if the DTL increases, my income tax expense will, if the DTL, which is the liability, increases, my income tax expense will go up. So when I write plus, I'm assuming DTL is increasing. I'm assuming increase. So I will write down here increase. Increase in DTL. But if there's an increase in DTA, DTA is a benefit, right? If there's an increase in DTA, my income tax expense will go down. So we do minus. Actually, in the formula, I write plus minus in the class. Why? So that you understand it can increase or decrease both. So if DTA liability is increasing, income tax expense will increase. If DTA increases, it's a benefit. Income tax expense will go down. Is this clearly understood, everyone? Check, confirm. All right. And one last thing about this topic, I already discussed about valuation allowance. Valuation allowance, we record it same like impairment and write down for DTA. So when do we recognize valuation allowance, guys? Valuation allowance. See, the impact I already shared with you. What is the impact? Balance sheet value will go down. Loss will be reported in the income statement. No cash flow impact. Reversal. Reversal, ironically, is allowed here in US GAAP also. So remember, the reversal is allowed. But because of valuation allowance, as I said, what will happen? DTA will go down. DTA will go down. The asset will go down. A loss will be reported in the income statement called valuation allowance. Cash flow, no impact. Now, if when do we record DT and detail? If it is reversible or not reversible? If it is reversible or not reversible, we record if it is reversible only. If it is not reversible, later on, first you record it, and if by any circumstances it is expected not to reverse, if expected I'm saying, okay, if it is not reversible at the front, if we know, we will never record it. But after recording, if you realize DTA is not reversible or DTL is not reversible, then as an analyst, I will treat DTA as, I will treat DT as, if not reversible, we will do the valuation allowance adjustment, right? But for DTL, if it is not reversible, very important. Yes. See, for DTL, as an analyst, what you will do? For DTA, we understood valuation allowance. DTL, if it is reversible and not reversible. If it is reversible, you will have to pay. So consider it like a debt, but if it is not reversible, consider it like an equity because it's something that you had to pay it and you saved. Is this clear to the class? Check, confirm, everyone. Right? Okay. The rest of the topics we have covered. So there is no formula in the financial reporting quality as such. And in the financial statement modeling also, there is no need of any formula. All right. These are the not exactly formulas only, but these are the essential things you may have to remember. Make a chart of it in your superb handwriting, not in my handwriting. My handwriting, you know, right? They're Chinese. So make a nice chart, put it up in your very beautiful handwriting, because only you can understand your handwriting. Like me, I can only understand my handwriting. But now you guys have learned from me. So you have one more skill. You can learn my handwriting. You can understand it. But you write it, stick it on your wall. FSA. All good? Everyone? Clear till this point? Perfect. Yes. Any questions, any doubt about FSA? Hmm. Everyone? Cool. Yes. Any doubts? Any concerns? Okay. A topic which is highly easy relatively to other topics. This topic has not too many formulas. There is one formula in reading number one about effective tax rate due to double taxation. So what is my effective tax rate? This very important. So we will take the corporate tax rate, the corporate tax rate that will be provided to you in percentage, plus 1 minus that. So 1 minus corporate tax rate, 1 minus corporate tax rate into the dividend tax. Dividend tax is paid individually by investors. So you can say either dividend tax or you can say personal income tax. So we write the general term here is dividend tax. But globally, dividend tax is paid based on what's your personal income. So income tax rate. So 1 minus corporate tax rate into the dividend tax rate. Do you know the hidden secret here? If corporate tax rate is 40%, dividend tax rate is 10%, together it's going to be effectively slightly less than 50. So you add and the answer should be below that. Are you with me on this? So it is corporate tax rate plus 1 minus corporate into dividend tax rate. You can check it out here. Effective tax rate. Okay. I have used in between payout ratio also. Why is that so? Because you may come across a situation where the payout ratio is not 100%, but I have seen the syllabus in level 1 and level 2 also that they assume 100% payout. So if it is 100% payout, this will be naturally 1. So this is my addition that I use payout ratio in the formula, but for your exam, since the payout ratio is naturally 1 as per them, then whether you write or you don't write, it's okay. So in the official formula, we use 1 minus corporate tax rate into dividend tax rate. But see, you guys might be aware about my way. I don't always follow the institute way because our objective is to pass the exam. So, and make sure that the logics are strong, right? So I use in my formula payout ratio also, but again, the institute says, oh, payout is always 100, which I don't agree with, but I want you to pass, so we'll not get into that debate. Okay. Is this clear, everyone? The effective tax rate formula, right? Any problem in this? Rarely tested, but still. Now, in reading number two, there is no as such a complicated formula here, but in reading number two, we understand the value of firm from the point of view of corporate governance and claim. So, what is the value of firm? This formula is repeated in equity. Value of firm is value of debt plus value of equity. Okay. Now, remember in this, I have made up a very nice chart in the notes. Now, many of these concepts I keep teaching, and students tell me, sir, not testable, not testable. We don't see this. I say, I understand, but I want to keep it. So, what is value? And this, because it makes your logic very strong. Remember, the equity owners will get the money only if the firm value is greater than the value of debt, isn't it? if the value is greater than debt. But if the value of firm falls below the value of debt, equity holders get nothing. So what will equity holders get? Equity holders, yes. Anybody, somebody? Equity holders will get the extra value, value of firm minus value of debt. But if the value goes down, zero. But debt holders will, if the value goes up, they will get the full value. If the value goes down, they will get whatever the firm value is, isn't it? They will not get their full value. If you allow me, I can connect this with options. But I don't want you to be feeling like, sir, what's going on? You said FSA. Are you okay if I connect this with option position? Yes. What is equity called as? Equity is something similar to a long call option because you benefit when the value goes up. If it goes down, the maximum you lose is your investment. Debt is like, yes, someone would like to add. Come on, you guys are, many of you guys have learned from me. Make me feel proud. Debt is like short put. Okay, write down for your reference. Long call and debt is like short put. Okay, we'll discuss that in options. But since you're writing the formula everywhere, write it. Got it? Got it? Guys, which of the two formula is affected by leverage? ROE or ROA? Which one is affected by leverage? ROE or ROA? ROE or ROA? ROE, because remember in ROE, the last component is what? It is financial leverage. So ROE is impacted with or affected with leverage. ROA is unlevered. ROA is also called unlevered. Unlevered. Why? Because it is not impacted with leverage. Is this clear, everyone? This is the critical aspect that you should know in case of reading number 2. Reading number 3 is all about ESG and corporate governance. Well, there was no formula there as such that you should remember. Reading number 4 was working capital. So apart from reading number 3, I'll go to reading number 4. Working capital is where you had plethora of information related to your ratios, activity ratios. So let me go to working capital. In working capital itself, we call it as what? Working capital is current assets minus current liabilities. Correct, everyone in the class. But there is something called net working capital. In that we exclude the cash components from current asset and current liabilities. So I have been putting this across. Rarely it is tested, but what we do, we take current asset minus current liability, but we don't take all current assets or all current liabilities. We only take the non-cash. So we exclude any cash and marketable securities or the short-term investments, right? Marketable securities is money market mutual funds or money market investments. From the liability also, we exclude any short-term debt obligation, any obligation of debt which is less than 1 year. That is called net working capital. Net working capital. Rarely tested, but we just discuss it. Cash conversion cycle ratio, we all are aware. Cash conversion cycle, I don't want to repeat it, but still, days of inventory plus days of sales minus days of payables. We already discussed the lower the ratio, the better it is. The most important in this case is effective annualized rate. Remember effective annualized rate or effective cost. This is the cost of using the supplier's credit or missing out on the supplier's discount. Now, I will write down the original formula which is here, but I will also tell you what is this related to. So many of you might be struggling, sir, what is this formula, right? So it is 1 plus a percentage. And what is a percentage? I will tell you. And there are two components here and the way it is said. So what it is a and 1 minus a percentage. Now I'm writing this formula, but let me tell you clearly that you do not have to use this formula. It is 365 to the power As soon as I write 365 divided by something, bell will ring that this is related to what, sir? This is related to what? This formula is related to what? And now you will see A slash B net C. So in the denominator, we write C minus B, C minus B minus 1 into 100. Now, first of all, what is A and what is B and what is C? So we always write A slash B net C means everyone, we write any example that someone would want to add here. How do we write A slash B net C? Means 2 slash 10 net 30. It means if I pay within the next 10 days, I will get the 10%, 2% discount, or else I will pay in the next 30 days. So basically, the discussion is about how many days of credit? 20 days. All right. So remember the technique that I do in the class, how to analyze this, that if you pay on the 30th day, you'll have to pay the full amount of the bill, let's say $100. But if you pay on 10th day, you will have to pay $98 only. You'll get a $2 of discount. All right. Now you don't have to worry about this formula because do you know this formula is related to what? Everyone in the class? It is annualized HPR. So if you do holding period return is ending over beginning. Everyone. So if you simply do ending over beginning, yes, for example, in this case, if I do 100 over 98, that you store it and you do to the power of 365 over the days. You take these days because this is C minus B. This is technically C minus B and this is your A. So I tell students, instead of worrying so much, you should simply do what? You should simply use your common sense here with respect to annualize HPR. So I will do 365 over the days minus 1. How many days am I borrowing? That you should be aware. Is this clear, everyone? So you will calculate the HPR here. Technically, what you will do, 100 divided by 98, store 1, and 365 over 20, 365 divided by 20, store 2, recall 1 to the power recall 2 minus 1. You will get an answer. Can you get me an answer for this using our technique? Everyone, just do 100 over 98, store 1, 365 over 20, store 2, recall 1 to the power recall 2 minus 1 into 100. Yes, anyone has the answer? Check here. It's 44.59 approximately. Clear? 44.59, right? That is the answer. Just for your reference, okay? It's just to test that can I use the annualized HPR also? Okay, everyone? Right? Perfect. Clear. That is one formula that you will remember. You'll compare that rate with the bank borrowing rate. If the bank borrowing rate is lower, you will take the bank funding and take the supplier's discount. Now, in the next reading, we have all about NPV and IRR. Everyone in the class, NPV is simply, again, we do it in the calculator, but MPV is the difference between your cash inflow and outflow in the present value terms. And IRR is the rate at a point where NPV is zero. NPV 0, that is your inflow and outflow matches. We all know the decision. If NPV is greater than 0, that means your IRR is greater than cost of capital. If NPV is less than 0, IRR is less than cost of capital. Cost of capital, everyone knows what is cost of capital or WACC. Weight of debt into after tax cost of debt plus weight of preferred into cost of preferred if there is preferred. Otherwise, weight of common equity into cost of equity. That becomes your cost of capital, which is also called WACC, right? So if NPV is greater than 0, your IRR will be greater than cost of capital. In that case, we will accept the project. Otherwise, we will reject the project. But if they both are same, we say indifferent. Everyone agrees with me? Guys, if there is any conflict in ranking, we always select based on NPV only. Is that clear to the class? Select based on NPV only. NPV only. There is also a formula about return on invested capital, same like return on total investment, right? That is what we compared with WACC. There's no formula there that you need to memorize. Just remember ROIC when you compare with WACC, you are testing whether the management is adding any value or not. So we compare those two ratios. No need to calculate that. We already know that. All right, everyone, clear? One formula there is that what is the increase in share price on the announcement of projects. So what do we do in that case? We take the NPV divided by what? The NPV that is expected. Again, this is expected. This is just a theoretical valuation, but we divide the NPV by the number of shares outstanding. So if we divide the NPV with the number of shares outstanding, that is the increase in share price because of the announcement of project. Clear, everyone? Right? Reading 6 is where we had started the topic with the WACC calculation, which I already did. WACC is also called marginal cost of capital or simply the weighted average cost of capital. In this topic, the most important thing is MM. Now, remember in there is part 1, Modigilani Miller, part 1, part 2, right? Part 1 and part 2 with and without taxes, everyone. So without tax and with tax. Now I have put up in the notes, but I will just write down here for your reference that MM1 talks about value. So it compares the value of levered firm with value of unlevered firm. Value of levered firm with value of unlevered firm. And MM2 talks about the WACC, weighted average cost of capital. What is the impact on cost of equity due to leverage? This is what MM2 talks about. Due to leverage increasing, what is the impact on cost of equity and what is the impact on WACC? First thing, in the without tax era, right? Says that it doesn't matter. Capital structure is irrelevant. So value of levered and unlevered companies same. So even if you increase the debt, yes, the cost of equity will increase, but the WACC will remain same. Understood, everyone? With tax, said no. If you have leverage, there is tax shield, which is debt into tax. So that is called tax benefit of debt or debt shield. This tax shield is the benefit, and therefore, why is the benefit? Because you borrow, you get tax benefit. Now, therefore, if the debt to equity increases, that is the leverage increases, cost of equity increases, but the WACC will fall down. In fact, at 100% debt, which is what considers optimum year, what will happen to the WACC of the company? Can someone tell me? At 100% debt, what happens? WACC of the company's lowest, which is equal to after tax cost of debt. Understood? This is what recommends. But then we learned a theory that, oh, it is not capturing everything. So when I say value of unlevered firm and value of levered firm, it is not just the tax benefit. There is a tax benefit. Yes, that is a tax benefit. Correct, which is adding the value of the it adds the value of the leverage company. But with the leverage comes what? With the leverage comes the stress. So we calculate the present value of distress, cost of financial distress. We say cost of financial distress. Now, don't worry, in exam, you don't have to calculate this financial distress, but it is basically the intangible cost or tangible cost about the default, the more you borrow. So, this is the appropriate amount of the value of the company if there is a debt and if there is a benefit and cost due to debt. This point where the value of the firm is maximized, that point is called optimal capital structure, or you can say optimal capital structure has a name also. It is called static trade-off theory. Optimum capital structure where the value of the firm is maximized. It is also called static trade-off theory. So, as per Modigilani Miller, go for 100% debt if there is a tax, correct? But as per optimum capital structure, no, go for the point where the where the value is maximum, static trade-off, where the value is, what is this point? This is the point where the value is maximum or the WACC is minimum. That point is called my optimum capital structure. Everyone clear with this? Right? All right. The last topic of business model does not have any formula. Perfect. Check. All good. Yes. Corporate issuer, sweet, easy. No complication in corporate issuer at all. Yes. Any questions about corporate issuers? Anyone? I hope the notes helps you to summarize it, just everything in two books, right? Otherwise, there's too much to read. All good till this point? Okay. Now, in economics, you have 8 readings. Majority of the formulas are concentrated in the last 2 readings of Forex. The first reading, form and market structure, doesn't have too many formulas, but still there are a couple of things that you should know. Is the very important point, which is what? The point of shutdown or break-even point, right? So what is the shutdown and break-even point? For that, you need to know what is average revenue, average cost, average fixed and average variable cost. First of all, average, mean, correct? So it's going to be divided by the quantity. Just remember before I start that average total cost is average fixed cost plus average variable cost. All right, everyone? Correct? Now, if the price or the revenue, see, price multiplied with quantity is revenue. If the average revenue is compared with average variable cost, you need to recover that at least. And then eventually you need to recover. Your revenue should be enough to recover the average total cost. But in this case, we understand 3 situations, as I said. One is that, is my average revenue sufficient enough to cover the average variable cost? If not, what will happen? If it is below, if it is below, if it is above, in that case, what we do? And if the average revenue is between these two means it is greater than the variable cost, it is greater than the average variable cost, but below the ATC. So it is greater but below ATC. So what will be my shutdown point, everyone in the class? So in the short run and in the long run, what will I do? In the short run and in the long run. Yes. So ever in the class, whenever the revenue is below the variable cost, we will exit the market or continue. We will exit the market in the short run and long run both. If it is above, we will stay in the market. We will continue. We will stay in the market short run and long run. But the unique thing is when the average revenue is above variable cost, in the short run, you will stay but in the long run, you will exit. Is this clear to the class? Understood, everyone? Right? Now, one thing that you may not be tested, but you should know economic profit. Throughout the topic of economics, we are discussing economic profit. Economic profit is different from accounting profit because it takes what economic cost. So it takes revenue minus the economic cost. And what is your economic cost? Economic cost is, yes, all your accounting cost, but it also includes a unique item called opportunity cost. Now it's not measurable, but that is what called economic profit. So whenever I say I'm making abnormal profit is economic profit, means more than my opportunity cost also. Now, this is not done. Remember this shutdown and break even point. So in exam, they may ask you what is the break even, what is the shutdown point, or what is the short run shutdown point. Short run shutdown point. And then there is something called long run shutdown point. And then there is a break even point. And then there is a break even point. So can you tell me short run, long run, and break even point, everyone? Short run shutdown point. I'll immediately close in short run also when the average revenue is below the AVC. I will exit in the short run also. Long run shutdown point is when the average revenue is not able to recover my average total cost. Break even point is when they both match, right? Break even point is when average revenue equals to average total cost. At this point, my economic profit is zero. So at break even point, my economic profit is zero. Is this clear to the class? Check, confirm. Right, correct. Very important in economics, reading number one was the long run ATC. The point of minimum efficient scale is the point where the ATC is minimum. I know there is no formula for this, but you should know this is called, it's when ATC is going down, it is called economies of scale. When it's going up, we call diseconomies of scale. All right, everyone. Now, in this topic, there's no as such an important formula, but a very important point. In perfect competition, what is the price? And in price in perfect competition and monopolistic competition, right? What is the price in this case? In perfect competition, price is, the demand curve is horizontal, right? So price is equal to marginal revenue, or it is equal to average revenue, and price is equal to revenue, price is equal to cost. There is no economic profit, so it is equal to marginal cost also. So price, marginal revenue, average revenue, marginal cost, all are same in perfect competition. Economic profit is zero. In monopolistic competition, this price is slightly higher than marginal cost to cover the cost of advertisement and selling expenses. Is this clear, everyone? In perfect competition, we produce till the point where MC equals to MR. So profit maximizing output. What is profit maximizing output? Now, this is so important. This is common for any form of competition, right? Perfect, monopolistic, monopoly, oligopoly. Profit maximizing point of output is where the MC equals to MR, marginal cost equals to marginal revenue. Please remember this. Okay, everyone, right? In this topic, the other formula which is important for you is N firm concentration ratio and Huffindel-Hirschman index. What happens in N firm? Let's say there are top three firms. So what we will do, we will simply add the market share. So we will add the market share of firm top one market share of second, market share of, let's say, third, if it is 3 from concentration ratio. In HH index, we will also take the market share, but what we will do, we will take the square of the market shares. Are you with me, everyone? Now, in HHI index, it is sensitive to mergers, right? So that is more important. Now, even though we learn in equities, but are you aware about what is considered high concentration, low concentration? Do you know the number? Low concentration, high concentration, and moderate concentration. What is that magic number? Below 1500. If the number is below 1500, it is called low concentration. If the number is below 1500, it is called low concentration. If the number is about 2500, it is considered high concentration. If it is between both, it is considered moderate concentration. Is this clear to the class? How to calculate that? Understood, everyone? Check, confirm, check, confirm, check, confirm. All good, right? Very interesting, right? I'm connecting the equity formula here also, because in economics, they don't tell you the number. In equity, they tell you what is that magic number. Okay. Now comes my two favorite topics, fiscal and monetary policies. So because the topic before this, that is the indicators about the business cycle, it doesn't have formulas, right? Fiscal and monetary policy, yes, fiscal and monetary policies have amazing formulas, and the most important is the multiplier. So we will compare both the multipliers, and I want everyone to remember that formula. But before we discuss the multipliers, there is one formula that if you have a fiscal deficit, and what is fiscal deficit, guys? Fiscal deficit is when your collection is more, no, your payoff is more. So your spending are greater than your taxes. That is called fiscal deficit. Opposite is surplus. If the fiscal deficit goes beyond a point, the government has no choice but to borrow. That is where we take the debt ratio, not of the company, but of the country. So debt ratio is debt, but we say aggregate debt. What is aggregate debt? Aggregate debt is the debt of the entire economy divided by the debt ratio. So divided by what? Divided by the GDP of the country. Everyone with me on this? Clear? Very important, this debt to GDP ratio, debt to GDP ratio. And then we discuss on the fiscal multiplier. So fiscal multiplier. For fiscal multiplier, you require a couple of components. That is marginal propensity to consume, and then there is something called the tax rate also. So the formula is 1 divided by 1 minus MPC. What is MPC? Marginal propensity to consume, but this into 1 minus tax rate. So you will do this 1 minus tax rate. Now remember, in the calculator, first you solve this, subtract this from 1, store it, then inverse. Okay. Then inverse. What is MPC? Marginal propensity to consume. The remaining is marginal propensity to save. Together it is always 1. Are you with me? What is balance budget multiplier? Now this concept is very, very important. Balance budget multiplier is that the budget is balanced. So the amount of taxes and spending is same or different. The amount of taxes and spending is same, but at this point, what happens? The net effect on aggregate demand. The net effect on aggregate demand. By the way, aggregate demand is nothing but GDP. I'll repeat. Aggregate demand is nothing but what? GDP. The net effect on aggregate demand will be increase, same, or decrease. Everyone in the class will be an increase. So even if the budget is balanced aggregate demand will increase. So at what point aggregate demand or the net effect on GDP will be zero? At what point aggregate demand is zero? Aggregate demand is zero at a point where I can charge more taxes. And that's what we call as increase in tax. So increase in tax is how much? So remember here, if the budget is balanced, means your spending and taxes are same, the net effect is positive. So if I want to tax more, I can tax more and still the budget will be positive. Till what point? That increase in tax should be equal to spending divided by the important element here, that is MPC. MPC. Now remember this. I mean, I'm writing it, but you know, you need to recollect what it was, why it was done, because just by writing the formula, not everything is justified. But I hope you get it, that this, my suggestion to the class is, what you need to know, there's no calculation that they will ask. They will probably ask you that you should check what is the taxes and spending. If they both are same, the aggregate demand should be positive. If they both are different, then that's where the issue will be. But if they both are same, budget is balanced, aggregate demand should increase. I have not seen CFA Institute making you calculate things, but they want to probably test whether you know the concept or not. Is this clear? Fiscal multiplier, yes, you should know the formula of fiscal multiplier. Yes, everyone understood this? Check and confirm. Okay. Now we'll go to money multiplier. Everyone, right? Money multiplier, very easy formula. Can you tell me what is money multiplier? Money multiplier. Money multiplier, the easiest of all the formula is simple. It is 1 over 1 over which ratio, guys? 1 over, come on, try. Which is the ratio? Which is the tool that we use in monetary policy? Monetary policy is about inflation and what? Money supply, right? Interest rate and money supply. So the policy, we divide it by one ratio, which is called which ratio? Reserve ratio. Everyone in the class, higher the reserve ratio, lower will be the multiplier, and vice versa. All right, this is very critical. Money multiplier, that will tell you the increase in supply will result in how many times increase in the aggregate demand. There is a concept called money neutrality also, which I have rarely noticed, and that's why tell students that you can probably skip also. I shouldn't say it officially, but I tell students you can skip also, because I don't see too many elements of that in the questions. But money neutrality, it's in my notes, so I will just discuss what is money neutrality and write down in the formula point here. So we are in monetary policy. Money neutrality compares an equation under which there are some constant and there are something which is variable. So it says that the money should, this money neutrality, this parity should match. So it is money supply into velocity. I'm writing it, but with very little hopes of it being tested, is equal to what? This is money supply into velocity. Money supply into velocity of that velocity is fixed, is equal to price of goods into output. Output is the quantity, right? So it is the real output adjusted for GDP. So this two things which are variable and two things which are constant, that you should know. Even if you don't know the equation, these two things are variable, and velocity, everyone in the class, and real output are considered to be constant. These two are variable. I am not expecting you guys to probably have some formula like this, but if they ask, uh, I don't know whether it is now tested or not, but I've not removed it from my notes. Just for your reference, you should know what is a variable and what is constant. Because of this, the central banks realized, yes, that the money supply has a direct impact on price. That means, remember, if the money supply is increased by the central bank, is it contractionary or expansionary? Money supply is increased, that is expansionary. So the price level will also increase. Inflation will also rise. That is what you should know. Got it, everyone? Check, clear? Clear? Any question, anyone? All right. This is the formula that you should know from this particular topic. Okay. Now we move into the next reading. Do we have any calculation in geopolitics? No, there is no calculation in geopolitics. Trade flows. There is no as such a calculation here, but I will discuss what happens in trade flows. They ask you something about exports and imports. Remember exports and imports, they probably will ask you what is net export. So we are now in international trade capital. Under this net exports, we all should know net exports, or rather I should use a specific term, trade balance or trade surplus. Trade surplus, guys, is when exports are greater than imports. That is what we call trade surplus. If it is deficit, imports are greater than exports. One thing which I want you to write and understand, because that equation is probably tested in the next reading, that is the equation of GDP using the output method. What is the GDP equation using the output method? GDP using output method is C plus I plus G plus X minus M. X minus M is exports minus imports. So C is consumption, I is investment, G is government spending, and X minus M is exports minus imports. This is GDP using output method. There is another equation, GDP using which method? Input method, that is income method. That is nothing but consumption plus savings plus taxes. You want, you can write down this. Consumption plus saving plus taxes. Consumption plus savings plus taxes. Is this clear? Have you written down this too? Will they both give me, or should they both give me different answer or same answer? Consumption, saving, taxes, and C plus I plus G plus X minus M. Should they both give you the same answer or different? They both should give you the same answer. All right. Keep that in mind. We will use it later on. All right. Now, in this topic as such, there is no too many formulas here. Yes, there are too many concepts, especially whichever trade restriction you put. Who will always suffer? Domestic consumer always suffers. Domestic producer always gains. With tariff, it's the government who makes money, right? With quota, the either the government or the foreign exporter. But in terms of export subsidy, the government loses because it gives benefit, right? In case of voluntary export restraint, the foreign exporter gains. I'm not going to discuss further, but it's not a formula, just that you need to know that is very critical here. Now, all of the formulas are related to currency. Are you ready to write down all the currency formulas together? Right? And now see how do we connect all these formulas. All right. First of all, base price. Remember, the institute always uses which format? Price currency slash base currency. All right. So it's the second currency, which is base. Now, whenever they ask you appreciation, depreciation for the base currency, and to the students who know me, I have used the same concept for if they ask you for price currency. So guys, our holding period written formula ending over beginning minus 1, correct? What is that technique? Ending value over beginning value minus 1 into 100. That is going to be your, if they ask you for base currency. For price currency, we do the shortcut beginning over ending minus 1 into 100. Is this clear to the class? Right? Remember, this is a comparison between the rates. spot rate today and spot rate after a year. But what is premium discount? Premium discount, guys. Premium discount. Premium discount is called annualized forward margin or simply the margin. Premium discount, guys, is between, if I want to find premium discount for premium or discount for base currency and premium or discount for price currency. Now see the similarity. Why am I writing it together? The similarity and the difference. So instead of ending over beginning, I will use the words now forward over spot. So premium over discount is between forward over spot minus 1 into 100. But if it's for price currency, it is spot over forward minus 1 into 100. Remember here, if they use the word, and see what I do, if they use the word annualized, only then you will do 360 over days. I'll repeat, only if they say annualize, either 360 or months. Okay, 12 over months. If they use annualize, if they don't use it, you also don't use it. Okay, you simply calculate the premium discount. Is this clear to the class? Check and confirm. Got it? Everyone understood this? The similarity and the difference. Now, guys, what is the difference between bid and ask? Or what is the spread? Spread is the difference between the ask rate, that is the offer rate, and the bid rate. Check. Are you there online, guys? Check, check, check. Right? Okay. Now, if I want to add or subtract the pips to the forward rate, so what do we do? To the spot, we add or subtract the pips and we get the forward rate, which is called outright forward rate. Now, remember the rule for pips or point, it is 1 divided by 10,000. So whatever pips they give you, divided by 10,000. If it is plus, add. If it is minus, subtract. 1 divided by 10,000. Why 10,000? Because it is 4 decimal for your exam. Is this clear to the class? Check and confirm. Right? Okay. Now, there is a concept about real and nominal rates, that we have the rates which is called the nominal rates. From the nominal rates, I want to convert them into real rates. And remember, whenever we say rates, they are always in direct quote. Direct quote is price slash base. And whenever I say price slash base, in the direct quote, guys, what is direct quote? First, let me write down that. In the case of direct quote, everyone, direct quote is a situation where the base currency and the price currency. Who's the base currency, guys? The base currency is the foreign currency and price currency is the domestic currency or the local currency. Is this clear to the class? Base currency is the foreign currency. I'm writing the short form. Price currency is the domestic currency. That's a direct quote. Throughout your syllabus, you have direct quote. So whenever I write price slash base, I'm also assuming what? Whenever I write price slash base, I'm assuming what? Domestic currency slash foreign currency. Now, this is not always the case, but if in the syllabus you will consider that wherever you see domestic currency slash price currency, that foreign currency, which is the base currency, assume it's a direct quote. So why? Because all the formulas are based on, domestic and foreign. I have converted all the formulas for me from price and base. So when I say real exchange rate of price slash base is equal to nominal exchange rate of price slash base into the ratio of inflation of both the countries. Inflation is in US, it is calculated as CPI. CPI is consumer price index. So we take the consumer price index of the base currency over the price currency. Is this clear? How to convert nominal to real? Everyone in the class confirm, let me know. For cross currency, remember, very important. Now, there's no formula for cross currency. I have used the technique in the class, but for cross currency, one of the very favorite questions of CFA Institute, in cross currency, there is a quote which is A/B, and then there is a quote which is B/C. So that will give you A/C. Now, this is just a formality, but remember here that the common currency is B, which is called the vehicle currency. And before this, you always have to check whether the quotes are in the order that you want. Means whether the quotes are in the order. If not, you will have to inverse. So when I inverse, what is the new bid rate? And what is the new ask rate? When I inverse, remember, inversing is difficult. If you directly inverse, it will be a mistake. Inverse is new bid is 1 over old ask rate, and new ask is 1 over old bid rate. Is everyone aware about this or not? Check and confirm. Cross currency, cross currency, cross currency. Clear? What if there are three codes given? Do you have three codes? Have you seen questions of three codes? Three codes, four codes, five codes? Whatever they give you, you always have to do the same process. You have to first check the currency codes, whether are in the same format. It's maths. So again, I have not seen it, but still let me address that. Let's say it's A to B, B to C, C to D, D to E. You at the end of the day want A to E. So all the vehicle currencies should disappear, right? So you will check and make an equation in a manner that they disappear. If they are not in the format, inverse it, inverse it, inverse it. So I want this format to make sure I get A/A. So let's say if they've given C/B, so first inverse, then multiply. If they've given D/C, inverse and then multiply, bid to bid and ask to ask. Understood? In case if they give. See, I'm very excited to say that, not everything that CFA Institute says happens in exam, but unfortunately, I'm binded by the ethics code. Otherwise, I would say, those who know me, I openly say it, whether you should do or not. But still, just for your reference, okay, whatever number of codes they give you, we are ready for it. All right. At the end of the day, the equation should be such that vehicle currencies are disappeared. The common currencies are disappeared. Perfect. All right. Now, my favorite is interest rate parity. First, I will discuss interest rate parity. Interest rate parity provides you two important elements. One is that how to find the forward. So forward rate equals to spot rate into 1 plus interest rate. The question is which currency, 1 plus interest rates of which currency. So as I said, we always do price/base. Here it is price currency over base currency, but also remember these rates might have to be adjusted for time. For example, if they say not for 1 year, if they say for 180 days, then I will do whatever the days divide by 360. Days divide by 360. This is how I will break the interest rate and then apply if the forward rate is not for 1 year. Is this clear to the class? Check and confirm. We use 30 by 360 days throughout Forex unless they mention it. Unless they mention, we always use 30 by 360 days convention. All right. Now, what is the purpose of this? The very important thing is that as per the parity, the annualized forward margin, that is the premium or discount, should approximately match the interest rate difference between the price currency and the base currency. That should match. If not, there is an arbitrage. Unfortunately, you don't have arbitrage in level 1, but in level 2 you have. What does this mean? It means the currency whose interest rate is higher. What happens to that currency whose rate is higher, if the rate of interest is relatively higher, currency in the forward is at premium or discount, that you should know. So the country whose interest rate is higher relatively, that currency will be at discount in the forward. The one whose interest rate is lower will be at premium in the forward, and the discount and premium will be approximately equal to the interest rate difference. So how much will be discount and premium by? The interest rate difference. Is this clear to the class? Check and confirm. Got it? Now, the final thing, this is the equation related to macroeconomics used in multiple places throughout the syllabus for trade flows, for capital flows adjustment. That is nothing but your GDP equation, related to GDP equation. So somewhere in balance of payments, you will require this equation. I will first derive what is the core equation. The core equation is C plus I plus G plus X minus M is equal to consumption plus saving plus taxes. I have just matched the two methods of calculation of GDP. If you cancel out the consumption, then there is a magic. The magic is that X minus M is equal to savings. I will go on that side, savings minus investment plus taxes minus G is what the government spending. Now, what is this components called as? Yes, everyone in the class. This is called my trade balance. This is called my fiscal balance. Everyone knows that, correct? Fiscal, the government spending and government taxes difference. This is my private savings and this is my investments, correct? This is basically my savings and this is my investments. Is this clear? They both should match. They both should match. Keep that in mind. They should match, correct? Also, balance of payment should balance. What does it mean? Means if there is a current account deficit, it should be matched with capital account surplus. And if there's a current account surplus, that should be matched with capital account deficit. This concept is called balance of payment. It should always balance. Is everyone clear with this? Understood? Check and confirm. Perfect. All good till this point? Okay. Yes. Now, as such, ethics does not have formulas. But what I generally do in the class when we do the ethics, we put more emphasis on understanding the concepts. You know how many standards in the class. Those who've been with me, I make them write all the standards. So how many standards of professional conduct you have, guys? How many standards you have? Everyone in the class, 7 standards, and within that the substandards. How many substandards you have? 23 substandards, correct? All right. Now, in this case, there are 5 places where you have some number which you should remember, right? I have highlighted in my notes. I will tell you where in my notes, everywhere. This I feel are very important in the ethics. Those 5 areas where you have the number, the first one is yes. Can someone tell me itemized statement? Yes. So in the case of duties to clients, we have to send to the client the itemized statement of all the debit credit in their accounts at least quarterly. So I will write down here the standard, the name of the standard, its name. I know you don't require the number, but what is it about, right? At least what? So which standard is this, guys? This is in duties to clients. I see, I will repeat again. Many students say that, sir, do I need to memorize? I say, no, you don't have to. But if you are my student, you should know. 3A. 3A is about loyalty, which is least today, prudence, and care, duties to clients. Under this, itemized statement should be at least quarterly. Itemized statement to be submitted to clients at least quarterly. I will write down at least quarterly. Okay, you can also write down the same. This is 3A. 3A is duties to clients. Then comes duty to employers, loyalty, additional compensation, and responsibilities of the supervisors. Now, after that, there is record retention, which is under 5C. Under 5C, there is a record retention. Now remember, standard 5 is all about investment analysis, recommendation, and action, where how your investment process should be. So under this record retention, very important, you should maintain record, if nothing mentioned, minimum how many years, guys? Minimum of 7 years. Correct? This is very important. This is 5C. 6 is about conflict of interest. In conflict of interest, I would like to tell many students who may not be aware, I have seen this in the institute's codes, is that there is a code called 6A. Can you tell me what is 6A? What is 6A? What is the name of 6A standard? Yes, 6A. Everyone, what is 6A? What is 6A? Yes, 6A is disclosure of conflict. Let me tell you, the CFA Institute has what we do in level 2. I discuss this with the students, is that disclosure of conflict has been changed to something that is first avoid and disclose, then disclose. So this, just for your reference, you should also write there, avoid and disclose. Write down this. Disclosure of conflicts has been slightly renamed, avoid and disclose. In this, there is 6C about referral fees. Referral fees. Now, referral fees 6C, members should inform their employers. So, inform employers about referral fees at least quarterly. At least quarterly. Is that clear to the class? Everyone in the class? Right? And then finally in 7B, you have two things. One is about signing of PCS, professional conduct statement, and membership fees, both of which should be done annually. Okay, otherwise your name will not have CFA. Is this clear to the class? Right. Just one small thing about GIPS. Remember, in GIPS, to get GIPS certified, how many years of data you need to give to the CFA Institute to get your GIPS certification? Minimum of 10 years of compliance. Means, I say 10 years means 5 plus 5. So 5 years compliance, then apply, and then additionally another 5 years. I have not seen many questions about it, but you should be knowing 10 years of compliance minimum. If you have started the company 2 years back, then another 8 years. Total criteria is 10 years of compliance to be GPA certified. Everything clear? Understood? Check, confirm. All right. Yes, this is the closure of our part 1 formulas. Remember, part 1 has too many formulas starting with QM. I've tried to cover maximum. I hope you have written with me and understood as well. Addressing your doubt for GIPS, the minimum criteria is 10 years. So you have to show 5 years of compliance and then apply for GIPS. And after another 5 years, you get the GIPS certificate. So it's minimum of 10 years of compliance total. Got it? Understood? Yes. Clear? Perfect. All right. Yes. So the question that you mentioned about LES questions, yes, I understand these LES questions are difficult, and but see, always understand in life also and generally also that something which is not in your control, don't put too much stress into that. Put only your entire efforts in what is in your strength first. So that question which are in LES, which are out of the box, and sometimes that makes you doubt the entire 6 months of prep. I tell students, yes, that 5%, 10% element will be there in real exam also, right? But my focus is what I know. What I don't know, I can't do anything about it, right? So that 5 to 10%, yes, will be an issue in the exam, number one. Second, there will be 5 to 10% in the syllabus that will struggle you even after doing my full course, my revision, my formula. You'll be like, sir, I did everything from you, but I'm still not confident. It's okay. Our focus is that 70 to 90% of the syllabus that I know, I should not lose out anything on it. That is what my objective in my institute is also the same. In level one, also in level two, also. In level two, you know what? This uncertainty is more. I don't want to tell you, but this CFA teaches you that in real life also, market is not in your control. Does it mean I don't trade? No, I trade what I know based on what I know, right? Does it mean I don't invest? No, I invest. Now, there will be always people who are saying market is disaster, there is an outlier effect, the entire market crashes. That will happen. But does it mean we don't trade, we don't invest? No, we do. So don't focus too much on those couple of LES questions. Yes, if they are related, I keep an eye on it. I add them and I discuss them with the students, right? But I will tell you one thing. For example, we'll do derivatives in the second phase. And in derivatives, you will see a question related to convexity. Okay. And people get surprised. How come convexity is coming up in derivatives? Actually, convexity is related to forward contract. Now, there's a full story behind it. Why convexity is higher with forwards and not with futures. There's an entire story, but now that's not in the syllabus. But in the LES, there is a question. Now, I used to tell students that there's no background about it. It's okay, you can skip it. But I saw, okay, that question in the LES again and again. And then I realized, okay, this is tested somewhere else also. So it's no harm in explaining. Now, that 5 to 10% things will be there. Okay. Is it mandatory or encouraged to read line by line? Do you need to read line by line? That's why I've published this book, right? It's two books, right? CFA curriculum is vast, massive. You read it, great, correct? The reason why, most of the people have bought this book is I've summarized that into two books. Now, I'm not saying this is 100%, but by now you will realize it. And probably after exam, you will realize why this book is important, correct? Understood? You can read CFA notes, but make sure you complete it. For ethics, yes, you read it to analyze and understand the language that they use. The language that I use is somewhat similar, right? I'm not using any complicated language. I'm using the similar language, and I've made a very high effort in using similar simple language. I'm not using a complicated grammar also that will distract you from what the questions are. So my questions are very much similar on the lines of CFA Institute because I don't want you to deviate from the language that they use, and you will not realize this, but their language is slightly complicated, not that easy. Okay, so we stick to that. Perfect. All right. Yes. Any questions further? Anyone? Okay. Yes.